everyone. Welcome. This is the monthly IBD Meetup monthly overview. My name is Roy Maddox. Wes and I are the host and the facilitators of this monthly meetup. This meetup is sponsored by Investors Business Daily, and we are one of the largest meetups in the country with almost 3,000 members. I am the chief market strategist and portfolio manager of a company here in Charlotte called Integrated Financial Strategies, and Wes is the chief technical strategist and also the co-portfolio manager. I've been hosting these meetings for close to 8 years now, and I have been employing CanSlim tactics for over 37 years over many different market cycles. So I've got a lot of experience that I can bring to the table that will hopefully help you and assist you in making your investment decisions tonight, and help you just make more money from the markets and take more money out instead of make more money and keeping it in there instead of taking it out. If you're not on our email list and would like to receive our comments, please respond in the chat and provide your email information. We are a private group who believe that we can change our financial destiny and lives by identifying and owning what we refer to as true market leaders. These are the stocks that repeatedly beat in terms of their earnings estimates and raise guidance. And they typically, these true market leaders from historical standpoint, they tend to go up for, a couple of years. And we'd like to look at 8 earnings cycles. And that's how you derive the full benefit of maximizing your investment results, is getting a couple of these, in a bull market. And make no mistake about it, we are in a powerful bull market that is due to digest and congest and consolidate a little bit. But in a hot CPI number today, that could not take the market down lower. So we had a hot CPI number today. It didn't impact the market at all, and we had an accumulation day on the market. So it's important to understand not what you think is happening on the market, but observe what exactly is happening on the market so that you can take advantage of that. We don't predict where the market might go. We just try to look at all the available information and just make some educated decisions. Because trading stocks and investing in the market, it's not really that scientific. There's more of an art to it than being able to have these firm guidelines and firm rules that you can achieve extremely high investment results from. The only way that you can really achieve the investment results that we all want, and that is triple digit numbers, is have concentrated positions and have some of these stocks that go up 2, 3, 4-fold. And we're off to a great start this year. In the last 2 meetup meetings that we've had, we've identified a number of those true market leaders, and we have been invested in them. And I'm sure you have been invested in these also. We'll talk about a lot of concepts that are in the book, How to Make Money in Stocks. And that's really my mentor, David Ryan, and also William O'Neill, who I met in 1988. And really, both of those guys changed my life because it gave me some core principles to develop my strategy, over time. All of us tonight, we aim to connect to this vibrant community online, this great social media online, and we're actually on Twitter. You can follow Wes and myself on Twitter. We're very active in terms of providing content and our comments on a regular basis. So if you're not following us on Twitter, please tune in. If you're a novice investor, don't fret, don't worry. Many of us were novice investors at one time. In fact, some of the most successful investors in the market don't have college degrees, but they just learned everything they could by reading the right books and the prudent study and the application of the techniques and tactics that we'll talk about tonight. The meeting will be, it will consist of two different parts. In the first part, we'll talk about we'll go through a slide deck, and I'll begin the slide deck and Wes will finish it. And in the second part of the presentation, we'll open it up and we'll talk about individual stocks, and really everything goes in the second part of the presentation. So again, thanks for joining us tonight. And we got a lot of great information to share with you, and we hope you enjoy it. This is a little bit about our Charlotte Investors Business Daily Group. You can find us online by Googling the Charlotte Investors Business Daily Meetup Group. And of course, this is our disclaimer. Everything that we talk about tonight, it is for educational purposes only. We are licensed financial advisors. Wes and I are, with many different licenses. But the presentation tonight, everything that we talk about, it's not to provide investment guidance. You need to speak to your specific investment advisor for that. Cookie CanSlim. And CanSlim is the acronym that William O'Neill developed. And he did a number of studies over prior market cycles. And he identified the characteristics that great leading stocks had. And we'll talk about a lot of these characteristics and criteria tonight. But this is the CanSlim acronym that you can find in the book. And for those that have followed Investors Business Daily, this is quite quite known to you. Okay, from a process perspective, we think it's important that an investment strategy and investment process should consist of three different factors: looking at technical analysis, considering fundamental analysis, and also enjoying the macroeconomic analysis background that's prevalent in the backdrop in terms of us looking at the economy and interest rates and what's going on with the Fed and economic growth, GDP, and things like that. We think that's important to have some knowledge about, because depending on where you are in the market cycle, various stocks and various sectors historically do better than at other times. Okay, when you hear about technical analysis, we're talking about things and statistics and indicators such as the MACD, that's the moving average convergence divergence indicator, price phase, stochastics, point figure analysis. But really the number one technical piece of information that we follow is price. And price dictates, of course, where the market is going. It's only important if you buy a stock that it goes up and that it's trending up. Now, in CanSlim, the M stands for market. And market is, I have found over 3 decades that the market conditions are paramount in determining whether or not you can have investment success. And typically the market is in an uptrend, it's in a downtrend, or it's under pressure, it's in a consolidation mode. We are clearly in an uptrend where the 10-day exponential average is over the 21-day exponential average. The 21-day exponential moving average is also above the 50-day moving average, and we're above the 30-week moving average convincingly. That tells us that the short-term trend is positive. In fact, we are in what's known as a power trend. And Wes will talk about this unusual situation. And we'll go through a slide that's very important because it goes through these power trends that we've had in the past, and we also show where we think we are today. So that'll give you some context and color in terms of where are we in the market cycle, in terms of, is the market over? Is this it, or does the bull market in fact have legs? And we think that the market will be substantially higher by the end of the year. We think that we've only gotten started because we're in new high territory in all the indexes. When you have more and more stocks participate, then this market's going to broaden out, and before it's over, we should have a powerful move, not just from where we've seen, but in the upside to come. That's what we're expecting. Breadth. When people and technicians talk about breadth, many of us look at the percentage of stocks above various moving averages, and commonly we use that 50-day moving average and also that 200-day moving average. We look at things like the advanced decline line and the new high and new low indicator. And we think that's really one of the most important indicators that you can look at. We found that over time, going back year after year after year, during all these market cycles, that a bullish market is equipped in a situation where the new highs are significantly higher than the new lows. The new lows have dried up, and you have a plethora of stocks making 52-week highs. In fact, when this market broadens out, we expect to see more stocks exhibit what's known as green line breakouts. That's a framework and time period in which they're going into new high, all-time high territory. We think that's very bullish. And of course, sentiment, we're looking at the National Association of Active Investment Managers, what they're doing, how invested are they. We're looking at the VIX, we're looking at the put-call ratio, volatility, and so forth. And then we may talk about some ratio analysis. How is the market, how is the S&P doing versus the bond market? How are small caps doing versus large caps? How are stocks doing versus various treasury certificates from T-bills, notes, and bonds, and so forth. And of course, we can understand if there's risk in the economy by evaluating how treasuries versus junk bonds are comparing. And also with that, we look at the high yield index option adjusted spread to see if there's economic risk in the market as well. That's something that you should be aware of as well. And then fundamental analysis, of course, this is all about CanSlim for us. And what Bill Neal found and proved that a lot of these many, in fact, most of these great market winners, I don't know exactly what the statistic would be, but it's in that 90% area, is that Bill found that stocks that grew their earnings at least 25% for the past 2 quarters, they typically checked that box. In fact, Wes and I look for stocks that can grow 100% over the last couple of quarters. And we're looking, what's neat about Market Surge now is that they just added a feature where we can see what future earnings expectations are. So there's new information that's provided on the chart so that we can see what the projected earnings estimates are for the next 4 quarters. And we think that's going to be extremely valuable. The AND, of course, in fundamental stands for annual earnings. And that's to wean out those that are one-time. They just had a one-time move in terms of their annual earnings growth, and then they turned back. Then it turned back down. So typically stocks that have legs to them. They're going to have earnings growth that has grown over the past 3 to 5 years, and that will continue to grow. We also look at return on equity and sales and margins, and return on equity of at least 17%. That's a great criteria. And we're constantly looking for something new. And that could be a new theme, new products, new services, new management, something new that is revolutionizing and that has a huge market that's revolutionizing the way that we live, work, and play. And of course, artificial intelligence is the big theme right now, and we're all over that. We think this is crazy, but we think this can potentially be larger than the internet before it's over. So we're going to have many, many, many months, and we believe years, where you're going to have the build out and all types of applications for artificial intelligence, from machine learning to robotics to generative AI, and solving problems, research, clinical research for medicine. There's going to be all types of applications. And we believe that the two primary beneficiaries of this AI build out, it's going to be the infrastructure in terms of building data centers and equipping them with cooling systems and fast processors. And of course, these processors are being provided by NVIDIA and AMD, who are two leading stocks that we're following right now. The L stands for supply and demand. Volume's important. And also, it used to be that stocks with smaller numbers of shares outstanding, this has been revised over the various editions over the years. It used to be small cap companies that had minimal float. Those were the big leaders. Now we're looking for liquidity, and we look at volume increases. Again, one of the criteria that I look for every single day are the stocks that are up on big volume, and stocks that are up 10% in price with volume increasing over 300% from the average trading volume over the 50-day moving average. That allows you to hone in on those very, very powerful movers that have something new. And it's an earnings report or a new development or a phase 3 trial or something like that that drives the institutions into that particular stock. And again, make no mistake about it, what we're trying to do is follow what the institutions are doing. And the institutions have footprints, and the volume is that footprint, and you have to be able to interpret that volume. And if you're able to do that successfully, you can identify those leading stocks and stay in them for the great wave that they take you on. And the I stands for institutional sponsorship. This is really important, and Market Surge actually has a feature here where you can see which top mutual funds and money managers own your stock. That's all you have to know. All you have to know from a fundamental perspective is fidelity and all that built those trillions and trillions of dollars. Are they following the stock, and are they adding to the stock? Is it on their buy list? Are they buying it? Are they doing it consistently? And we have the right tools such as Market Search to see what those institutions are buying. That is very, very important. We never buy stocks that the institutions are selling, stocks that are in downtrends, and stocks that are, stocks where their sales from Wall Street, and after an earnings report where they miss. And that is one of the most important times to take your loss and take your loss is to sell when you have an earnings report that is not received the way that you would expect it. That's all you need to know. The earnings report, if you expected it to be good, And it doesn't matter if they missed or not. What matters is many times it's the conference call and how management is phrasing things and what type of guidance are they giving you in the future. That's why you can see stocks that actually miss, and gee whiz, these stocks go, they go up tremendously. So it's not necessarily what the companies report, it's how the market responds. And of course, market direction, we mentioned that before, that's crucial and important. And the last leg in the stool for developing a great investment process is really considering macroeconomic analysis. Now, it's a very broad, when you look at the macro, you're looking at GDP, you're looking at the debt and the economy, you're looking at our growth rate, you're looking at inflation, you're looking at all kinds of things. It's massive. And we have found that it's very difficult to just invest based on the macroeconomic analysis because the market front runs that. In fact, we have expected, and Wall Street has expected a recession for the last 2 to 3 years, and we just haven't had the data and the slowdown in the economy that suggests that we would be in inflation. But we do subscribe to Hedge Eye Research with Keith McCullough at Hedge Eye Research, and he does provide some interesting commentary and information that we find useful just to be aware of, but we would never invest based on macroeconomic analysis only. It would be, it's important to just really look at price. And so price, you can look at the fundamentals to get you in, or the technicals for timing, and the fundamentals to keep you in, and then the technicals to get you out from a selling perspective. This is the way that Hedge Eye has broken their process out, where they measure and map the rate of change in global economies across all asset classes, and they plug that data into a predictive tracking algorithm, and that provides the data, the industry groups that should be doing well based on where we are, either in a quad 1, quad 2, quad 3, or quad 4. Again, you can get more information from Hedge Eye on that. And with that, let me turn it over to Wesley, and Wesley will take us through the slide deck. I think that you'll find the slide deck just incredible. Wes has put a lot of work into this, and you can use the slide deck for study, for review, and just like many of us have a model, we have model books where we have our own model books where we put in stocks that we've owned over the years, and we look at those on a regular basis, because all we're doing is trying to use pattern recognition to find stocks from a technical perspective that are in strong uptrends, and be able to duplicate that pattern. And these patterns give us entry points, and that's what technical analysis is all about: is finding patterns such as bases, cup and handle formations, double bottom bases, high tight flags. There's a whole symphony of these setups and types of patterns that have and do lead to higher prices or lower prices if you're if you prefer to play on the short side. So with that, Wes, let me turn it over to you, and you can take us through the rest of this portfolio, and then I will come back and we'll talk. In fact, what I believe the most exciting part of the presentation, it's talking about the individual stocks that can change our life. And we have a number of these right now. We have a number of stocks that are up over 50% that we think have a long runway ahead, and we'll share those with you tonight if you haven't followed us, and we'll be happy to answer any questions on individual stocks. But we think you'll enjoy it. We certainly do. So thanks again for attending, and let me turn it over to Wes.
All right, thank you. Okay, so yeah, I'll get going with some things that we're looking at over the last couple of weeks, and hopefully give us, just give us some more context about the overall market, and go through some of the typical charts we look at, as well as some just more maybe pertinent ones to start. And so this is the cover of Barron's. I mean, I think people probably on this call know that Barron's is famously kind of used as the contra-indicator, right? So if we're getting bullish on the Barron's cover, then it's time to get bearish in your portfolio, or vice versa. I threw this out there just because it's we've seen bullishness sentiment, absolutely bullish sentiment, and we'll see it in some of the other surveys we look at. But then, you look at the market action, you look at different actual bullish or bearish indicators based on positioning. And you would say, okay, that's actually not excessive bullishness. So, I put this out here just because it's something that is highly talked about, but we'll see. It's always, it's always important to be aware of if you are getting exuberant. And I think if you were trading personally, you may have felt some of that kind of exuberance Friday in your personal accounts, and then to have the kind of severe reversal Friday as well in some of these leading stocks. So, anyways, thought this was interesting, an interesting call out.
Stop again, Daddy. Come on, girl.
Okay, I don't know who's talking, but please mute if you.
I just did. I muted them. That was Elaine.
Okay, great. And so we wanted to talk about a couple things. Obviously, we had a really powerful update today, but Friday we did see some of these warning signs, and I think people, a lot of us probably noticed. We had this gap up and reversal in the NASDAQ, and that was kind of accompanied by some distribution days piling up. Recently, we did have an accumulation day today, as Roy mentioned. So, this was something that made us get a little bit cautious, a little bit. We went from about 80% long, like in our portfolio, to about 40, and I think now we're about 60% long again after today with that strong bounce. And so, we did do some things to get defensive, and maybe that was early. Maybe, this market is just showing itself to be extremely strong day after day. And this is another reason why, we sold a little bit on Friday. This, NVIDIA, the leader of this market, the, face of AI, blowing through kind of this upper channel. And if you had some of the Bollinger Bands on there, you'd see the same thing, right? It's a pretty excessive move to the upside. And this is a textbook kind of sell signal for a lot of people that practice looking at candlesticks and everything. This outside day to the downside is usually an important indicator of a short-term top. But this is the leader, and it came to the 10-day and bounced really, really nicely today. So it's yet to be seen, but it's just it's really showing again the strength of the market, and especially some of these AI things, NVIDIA, SMCI being another, just powerful. And I wanted to look through some stuff about the Fed, and there's some things about performance after rate cuts, because I know everyone's kind of looking forward to and trying to anticipate when the Fed's going to cut. And we think, this is actually bullish. I know we've talked about in the past probably how rate cuts can actually be bearish, right? When you get rate cuts. And I think the context of these rate cuts is super important because, of course, if there's a rate cut because of a recession, that puts us in a whole different situation. You can see 6 months after the first rate cuts. This is actually from IBD, by the way, but you can see the performance 6 months after the rate cut, and clearly the negative ones that stand out, following the internet bubble in 2001, we had a recession. 2007, also, a horrible recession. So, yeah, just wanted to point out, we actually are going to anticipate this to be extremely bullish when we do start to get rate cuts, as long as we don't go into that kind of nasty recession environment. If that's why we're cutting, then that changes the whole scenario. Okay, and I looked at some other data. This is a different chart, kind of inspired by Ned Davis Research, who we use as well. And this is a look at the S&P performance this is the 12 months leading up to a rate cut, and then the 12 months following a rate cut. And that to us, that's of course overwhelmingly bullish on average. And I think I looked at 10 to 15 different instances. Maybe some of these that were included back here on this table as well. So that's definitely something interesting to pay attention to. The key here, it's always a little bit different, right? Every market environment. And what's interesting to consider is how much of the rate cut are we discounting now, right? Because clearly, typically in the year ahead of a cut, we just go sideways. Well, we have not gone sideways. We have not gone sideways since, we've gone pretty much up and to the right for a few months following the sort of Fed pivot of putting rates on hold. But here's another, indication of where why we can look at this market as bullish, right? There's a lot of things kind of aligning for us, we think, to make this an extremely bullish year potentially for the S&P and the leading stocks that we're in. And so this is the presidential cycle, just where we are in that 4-year cycle. It's an election year. Typically, we go sideways for the first half of the year in an election year. We are here, so that's halfway through the first half of the year. So we're about through a quarter. And then we bottom in May or June. I think that's June where we bottom. So, if this is going to hold true, this cycle work, then we're likely to have some tailwinds going into the election and following the election, and or I guess it won't be their first term regardless, but whoever's term ends up being in office. So something else interesting here is you bottom in June and have a good run. It looks like, I think this is about October, where you do have some kind of election jitters enter the market prior to election day in November. So that's something I think that's important. I think I wouldn't be surprised, right, to see that type of seasonal outcome as well. Okay, and we're looking at this. This is just the leading economic index. It gives you an idea of, I guess, where the economy is going. And it uses I guess, an aggregation of different indicators that that are good leading indicators, right, for where the economy is going, if we're going to grow GDP. And you'll notice how negative this has been. And what's been so odd, right, is that GDP actually didn't go negative, even though these leading economic indicators did. And a lot of that might have to do with government spending propping up GDP, but the point of this is you'll know. I mean, this is really, really negative for this LEI, and to us it looks like it's bottoming, and you'll see it's still declining. It's still in negative territory, but when you get out of negative territory and go into positive territory, that's going to be very good. That's going to be very good for the economy. So to us, this looks like the economy that's in the process of bottoming, actually. And so that means there's still a lot of upside if we have some growth. I wanted to point out this. I saw Ryan Dietrich point out this chart just to give us a reminder of kind of what a typical market pullback is within any given year. And so this is the maximum drawdown of the S&P 500 by year. And I highlighted the top 5 years for that, right? So ones that had really, really small pullbacks. And you'll notice, of course, I mean, it's only been 2.5 months for this year, but we're off to a really, really great start with a very small pullback here. And we'll see, there's a lot more time left to go in the year. But, I just wanted to remind people, you are going to get these pullbacks typically. The average pullback within any year is 16% for the S&P 500. And, just to know that that's in, the normal course of things. And also, when you're concentrated, right? If you guys are all kind of here to concentrate in 5 to 10 stocks and market leaders, you're going to experience some pullbacks that are bigger than that. So just keep that in mind as far as protecting profits. When things are really good, right? And we talked to, or me and Roy were talking about improving your worst case scenario the last week or two, and that's just something to be cognizant of, because if you're down 60, if the market's down 16%, stocks we're in are going to be down 30%, and so you don't want to give back that.
And Wes, let me just say, let me point this out in a great chart, Wes, on that, because that's great, because we can go back and put everything in a historical context. That, of course, the market is average, the S&P's averaged maybe 10% a year the last forever, 80 years, since World War II, 45. But you've got to experience and go through these pullbacks. It's not just a straight up the whole way. So you can see, even after when we go through these bear markets like 2000 to 2002, you still had in 2003, which was a great year, you still had a 14% drawdown. And so that's a 4-year drawdown right there. That was amazing. That could have crippled you. And even, when we started a new secular bull market, you still have these drawdowns. So, keep that in mind. And, 2000 to 2002, then 2007 to 2009, and, 2009, when the market bottomed and we went up, you still had a 27% drawdown there. So, that is just, that's the stock market. So that's the volatility. It's measured by the variability in terms of how much you deviate from from a distribution phase. So it's important to look at that. On the way of earning 10%, you still have this standard deviation of 16% that you have to contend with. There are a couple of ways of reducing that. One of the ways is selling into strength. So, with all these stocks and that we have and other people have as well, when we saw the NVIDIA, the blow off through the Bollinger Band, and then the outside date of the downside, that's a very bearish pattern. That's a sell signal. And we were surprised, and actually, and I'll show this on the charts on the second half of the program. Once we're in these power trends, you can expect a pullback to the 50-day moving average a number of times. And really, that really would be our short-term target right now, to think that we have another 5% to go to hit the 50-day. And we think the 50-day, of course, it's buyable there. But if we can't rug pull you right here, if they can't rug pull you here, that is just showing you have all this money on the sideline, that any opportunity they're stepping in there and buying. And that's what happened with NVIDIA. Today, NVIDIA didn't even make it to the 21-day. We were hoping that, and it still may do that, in time over the next few days, but certainly the institutions came in and supported it right at the 10-day exponential average today. So to improve your worst case scenario, we sold half of all the stocks that we have almost, but we just wanted to book the profits so that we can buy them back as they come in. We think that we have, we know the 10 or 20 leading stocks in the marketplace that you want to buy on pullbacks, or as they digest. In a strong bull market, you have in the digestions sometimes take they look like they put in like 2-week or 3-week tight patterns. And in the book, How to Make Money in Stocks, O'Neill talks about that. And these are typically add-on places to add. But if you're not in there, if you don't own any of these stocks, you have to use those 2-week and 3-week tights to initiate your positions. But if you do, if you're initiating for the first time, you just have to be tighter on your stops, because, NVIDIA that's almost doubled from 500 to 900, you're going to have to use a tighter stop, because the higher that it goes, the more brutal that pullback can be in these individual stocks. And growth stocks that we traffic in, those stocks in the FFTY, those are twice as volatile as the the beta is 2 times what the market is.
All right. Thank you for that. So just to continue on with this this drawdown theme, this maximum drawdown theme, I just ranked the top 10 years by lowest drawdowns experienced within that year to show you what the S&P 500 performance is during those years. So naturally, if you have really, really small drawdowns, you'd expect very good S&P 500 performance. And that is the case with 23% average gains. And actually that 23%, now that I'm thinking about it, must have included 2024, which is 2 months into this. So the average a little bit higher in reality for the full year. So yeah, if this is the case, if we're going to have one of these historic years of low drawdowns, it's possible. It should be a good year.
And Wes, pull that up one more time. This is something to really take a look at, so you can see, we haven't had much of a drawdown for whatever reason, and it's probably the market is front running how it typically does after when we don't have a recession and we have the first Fed cut. And even with the hot CPI, see, the market is front running that. People are aware of this. And this suggests to Wes and myself, if the maximum drawdown has been 1.7%, and we're only up 7%, I mean, we think this market is going to be much higher by the end of the year than people expect. I mean, when you survey Wall Street analysts at the beginning of the year, their estimate 10%. I mean, we think that we're going to have a 20 to 30% move in the S&P. And with that, if you're in these growth stocks from here, you're going to do twice what those averages are going to do. So we think, and now you see that, you see when the S&P is up 7.4%, we're up 22% for the year. You see that big difference in terms of how much stocks can appreciate versus the indexes. And so we think that we're in we're in March. We got 9 more months of this. We think it's going to be spectacular based on what we see and what we've experienced in the bear market in the last few years.
Yep. Yep. So yeah, we know today we had the CPI news again. So it was a little bit hotter. Market shrugged it off. So there's a little bit of an acceleration kind of occurring, 3.1%, then 3.2% year over year reported today, and then the projection of 3.3% going into March right now. So it kind of looks like we're stuck at this 3% level. This orange dotted line being the PCE and the Fed's preferred measure, that's getting closer to 2% still over the next couple months, but still a little bounce in the forecast for PCE right now too. So you have to contend with that and maybe just consider, okay, are we stuck here? How are we going to get it down to 2%? Like the CPI should probably follow and get to 2%, right? But you wonder if there's going to be any shaking of confidence in that. I don't think so. We don't think so. The market doesn't think so today. And I'm going to talk about this again, which I think I've talked about the last couple months. The core CPI, this is slow and it's on its way down. This is what's going to drive the CPI down to that 2% target. And largely what's going to happen is shelter's still coming down. Shelter is lagged. It's very, very lagged, right? So it's nowhere near where its long-term average is still. It's going to go from 6% to 3%, and that's going to happen over the next 12 months. And that's going to be a good driver to the downside for CPI and continue to give the Fed the ability, we think, to ease and later in the year. Who knows when exactly, but that's probably still the case. And here's a look at the Fed funds futures to talk about where the market expects the Fed funds rate to be over the next for the rest of the year. And you can see there was a little bit of an uptick today. So this black line is today's projection of where the Fed funds will be, whereas yesterday is in orange and a month ago was in gray. So there was just a tiny, tiny uptick with the latest CPI report, but you can see it looks like right now there's a possibility of the Fed cutting in June and a more likely chance that they cut in July. So that's what the market's saying still. And this is clearly, a big change from a month ago, way less aggressive, but still looking for that cut later. And then here's a look at the 1 and 2 year. They're really trendless at this point, right? But as long as these have peaked, we think that that has clearly taken pressure off the market. So nothing, I don't know, to really comment on with that. Here's the 10-year U.S. Treasury. A little bit of an uptick in Treasuries with that CPI report as well. Again, I consider it kind of trendless too. And one thing that we were talking about with maybe earlier this week too was, even if CPI accelerates a little bit more from here, that doesn't mean the Fed has to raise rates or anything. Most likely what would happen is rates would just bounce a little bit higher and sort of do the work for the Fed. So maybe, if it goes to 3.4, 3.5%, then the 10-year just drifts higher, maybe 4.5%, and that keeps a lid on things. So it's all a system that feeds on itself, right? So rates go higher, CPI goes lower, rates go lower. It's I forget what that, it's a kind of cyclical circular reference type of relationship there. So I'll look at these charts that we've taken a look at every month. This is a look at the Qs. The Qs have really been riding the 21-day up. Again, just highlighting some follow-through days, and we got long in August, got stopped out, got long in October, got stopped out, and then again, finally in November, just with the discipline of buying stuff on follow-through days, after follow-through days, was able to get some traction and get pretty heavily invested and ride this trend. To us, I think it's pretty clear that the bear market in reality ended this October. So a year after the indexes bottomed is really when the bear market came to an end. And if you were to look at the Russell 2000 as an example, you'd see kind of why that was, right? The Russell was almost making a new low on this day, even though the NASDAQ was maybe up 10% off the lows in October 4 months ago. So we got that, this MACD confirmation again with the follow through day, and it stayed overbought for a long period of time, and you've kind of just slowly been trending higher while the MACD has not really done anything noteworthy over the last few months. And here's a look at the moving averages that we look at to determine the trend. The green line being the 10-day, the magenta line being the 21, the 50 in yellow, and the 200 in red. And so, we got all these moving average crossovers to kind of confirm a change in trend. And now again, the NASDAQ riding the 21-day, showing how strong this rally has really been. If it's not even coming to the 50-day, where um, it's been quite strong for 3 months. And I don't have it marked here, but I know we have in the past about where the power trend officially started. The power trend, I would encourage you maybe just to look up the definition of it, but really what it has to do with this 21-day being above the 50-day, and then the index prices closing above the 21-day for 10 consecutive days. There's maybe a couple other things in there, but the power trend I think started right around here. Probably one of these 5 days here. And that's something that IBD has talked about a decent amount, and it's a very, strong trending market. So that started here, and we think that if you look at prior power trends, you can see that we're actually, on the earlier side based on the other, um, prior power trends that we've seen from IBD. So dark green, this dark green line is where we are today, and then you can revisit this slide when we send it out to look at some of the other power trend years, and these are real strong, sustained 180 trading day type of trending rallies. So we're about 75 days in, let's say, for this power trend, and history would say you've got at least another 100 before the power trend itself ends. Okay, and here's a look at the NASDAQ versus the 30-week moving average. This is one of our long-term trend criteria, and so we're firmly above the 30-week, firmly now in really a long-term uptrend. So we'll go through some breadth readings. Here's the S&P and stocks above the 50-day moving average. We did see that come in in February, now bouncing back a little bit. So, getting into that 80-90%, maybe a little bit overbought, and we've had some pullbacks, but still relatively healthy when you have over 50% of stocks above their 50-day. And then here's stocks above their 200-day. That continues to hold up really well for the S&P. Back in the 2020 and 2021 bull markets, we saw that number get closer to 90% and stay there for a number of months. So, we're looking for that to further strengthen if this rally keeps going. And here's the NASDAQ versus stocks above the 50-day. That has not had the same amount of participation throughout this rally, and still not much of a bounce. So just 45% of stocks above the 50 here. So, hopefully looking for a bounce in that and more participation in the NASDAQ. And then here's the stocks above the 200-day within the NASDAQ. Really just, gone sideways for the entire 2024 year so far, while the NASDAQ has made new highs. So, you really do want to see breadth pick up here in the NASDAQ. You'd like to see broader participation. But for now, we just haven't seen extremely high participation. And there's been a lot of minefields through a lot of blowups in earnings season. So maybe a lot of those stocks need to that gap down need to repair themselves on their charts and get back above the 200-day. So still not huge participation, but you can kind of see you might be on the precipice of really kicking things into gear with this, maybe getting above the 50% mark soon enough. Here's the NASDAQ and net new highs. So, this is something we want to see persistently blue for a healthy bull market where you have more net highs, so more new highs than new lows. That's what you see with this blue reading down here. And context for 5 years. Here's the net new high indicator down here with the NASDAQ up top. And so, when you get into these persistent bull markets, it should be months and months and months of this net new high reading. And so far, you can see that there's been about 3-4 months of net new highs. And now here's the New York Stock Exchange index and those net new high numbers, so a different universe of stocks. And that's, again, it's kind of showing the same thing, but just a different maybe broader different kind of sector focus in the NYSE index. And over the last 4 or 5 months, same thing, right? New highs. And you can see the index itself making new highs too up here in this chart just recently. Okay. And now here's the McClellan oscillator versus the S&P 500. This is one of our preferred measures of overbought and oversold. This is something that we noticed in November and December, how it was kind of persistently showing us we were overbought, and people have noted and shown that in the past, when you stay persistently overbought, that's a very good long-term indicator. So we were definitely aware of that, then, and waiting for some kind of pullback. But this definitely bodes well for the market. Right now, we're in no man's land for this oscillator, but still, this overly or consistently overbought condition was important to building kind of conviction in the longer term rally in the longer term trend changing. And
Wes, are you there? I think Wes's computer locked up. Do you guys hear me right now?
yes.
Yes.
Okay.
We can hear you.
Yes.
I'll give Wes a moment here. He may log off and log back in. Otherwise, yeah, I think he logged out. He'll log back in, and I will.
Whoops, I got kicked off.
Okay, there you are. Good. Welcome back.
Hey, it was just short, right? Where was I? Was I on the
Yeah.
VIX or was I on the McClellan?
McClellan oscillator. Yeah.
Okay, yeah, just right here. I mean, I don't know if I don't want to repeat myself too much, but anyways, this is the NASDAQ McClellan oscillator. We were just looking at the S&P one, or the NYSE McClellan. And so yeah, we noted that this was persistently overbought. November, December, a good indicator that the long-term trend is changing. And I know we noted the changing market character in, I think, December is maybe what we called the meeting there, just the persistent overbought nature really being important for launching a new long-term uptrend. So here's the VIX. Living below 20, that's exactly where we need to be for an uptrend. It's become a much easier environment to trade in and concentrate in stocks in. So this still just bouncing under 20 shouldn't be any problems while we're in this range. This is an indicator that shows net long exposure for active managers. It's a survey. And so this shows, when active managers are getting pessimistic, they're very underexposed to the market. And then when they're getting extremely bullish, that's when you hit that 100% plus long exposure from this survey. And so we're sitting at 94%. And I think it's an interesting important indicator to watch for sentiment. I like it because it's kind of it's a hybrid of survey work, which isn't great at timing, but also apparently, it is talking about where people are actually putting their money. So you can see we got this pretty severe pullback. in July when it peaked above 100. And then in December, this peaked above 100. And we actually did have it was a pretty nasty pullback for a lot of the things we owned in the FFTY from the end of December to the first week of January. So it is something that I think you should perk your ears up when you see it in that over 100 range. Okay, and this chart is looking at the AAII Bull Bear Sentiment Survey. And so we have the bulls in black here and the bears in red. And this kind of goes back to the Barron's cover where we're seeing kind of excessive bullishness, based on the mood of people, right? The survey work is saying that people are very, very bullish, and if the main publications out there are also putting these extremely bullish covers out there, it's something that makes you scratch your head just a little bit. If are you getting sucked in? Are you getting too excited about making money in this market? So just be wary of what can happen when you're there. However, I always caveat that with, okay, of course you're going to have bullishness in a bull market, and it takes bullishness to have a bull market. Otherwise it wouldn't exist. And so, you look at all these periods of time when the indexes are powering higher and there's, huge net bullishness. This is when the bulls are outpacing the bears in blue and the bears outpacing the bulls in red. So, again, I'm not putting too much credence in this survey stuff necessarily. I prefer, this is a preferred measure of excess bullishness and bearishness. This is the put call ratio. So when there's, a high ratio of puts being purchased versus calls, that's telling you that there's some excessive bearishness. This 1.0-ish level, that's telling you it's neutral, right? So there's no excess bullishness, there's no excess bearishness where we are today. So despite this massive rally, we're still not getting too complacent, in the market, it appears, based on this info. And this is the equity put call ratio, so just a subsegment of that. And again, not telling you, it's average, right? You look back historically, it's not noteworthy. We've had some different spikes in bearishness throughout the last several months, and you'll notice I think it has a really good track record at the extremes of noting or calling a turning point. Now here's the high yield spreads. This is the credit risk measure. So if this is widening, that means that there's the market is saying that there's more credit risk out there. This continues just to be in a downtrend where credit risk is just not on anyone's radar right now. It's not the market's not sniffing at anything in bonds that the equity market might be missing. Okay, and I wanted to add this chart in. This is something kind of new. But it's something we sort of look at because Hedge Eye looks at this to some degree as well. They have a slide every day that talks about it in a different way. But this is looking at futures positioning. So they have this report that comes out every week that talks about if you have commercial participants, that's in red. And then you have speculators in blue, large speculators in blue. So that's like your hedge funds. And then you have small speculators in yellow. So that's like your, that's like one of us if we had a futures account. And so what you're supposed to do is use this to look at extremes as well. So I wanted to add this into the sentiment picture to give us an idea of where we might be based on this data. Just another tool. And if you haven't heard of Jason Shapiro, I think he does really, really interesting work. He only trades off of this. He writes this report called Crowded Market Report, and he's in the Unknown Market Wizards book. and I think he's a really interesting guy to follow. And he's got a YouTube channel that he's kind of ramping up now. I think he just wants to give back, and this is what he uses entirely for trading. And so you look for extremes. This was concerning, as I was listening to him, um, and seeing the data where the commercials were net short. So the commercials are considered the smart people in the building. But you can see, despite that, the market has continued to rally, and the commercials have gotten less short. So now we're in this position where, again, similar to the put call that we looked at, it's kind of neutral. It's not saying anything. It's not crowded in either direction, and that should encourage you to think that this trend could easily just continue from here. The uptrend, at least in the market, could continue. And then this, I might continue to put this in too, but this is what I mean from Hedgeye, how they look at it a little bit differently. Basically, what we look at on a weekly basis from them would be this 1 year and 3 year Z-score. So what that's saying is, how outside of normal is the positioning? So we were looking at the NASDAQ back here, right? So this is the commercial positioning is slightly net short, but the speculators are a little bit long. So this looks at the speculators and how long they are. You can see it's a really, really small number. So it's I guess when you're within 3 standard deviations, it's not a big deal, right? So this is not telling you anything really actionable. It's saying that it's not crowded in any direction. If all of a sudden the NASDAQ futures positioning was negative 50,000, you might see this say, this Z-score would say, oh, it's minus 3.5. Well, that would be an extremely, extremely net short position in the NASDAQ. And that's something that would be, noteworthy. That's saying you're getting a little bit crowded on the short side. So anyways, I might continue to add this, and I think it's interesting data, but the axe on this data is Jason Shapiro. I'll go through, there's a few more here. I just wanted to put in the chart of Bitcoin. I'm sure we're all following Bitcoin if we're at this meeting. There's some volatility around the ETFs getting added right here. I know it shook us out with this pullback. You go below the 50-day, you have no idea what's going to happen. But it rallied, it set up again, and here we had this low cheat, maybe you could call it a low cheat VCP type setup, Markman of any special. And then here where you run up, consolidate again, and break out. So we're looking for short pullbacks to get in there, and we can talk more about it. But the ETF could be fueling a ton of fund inflows, just now that there's access to a lot of different institutions. Wanted to point out gold, because gold we've been talking about for years, and it's kind of we've thought that this huge multi-decade base was going to break out to the upside, and it looks like it finally did. So gold has taken off the last 7-8 days, and then this is what it looks like on the monthly. So this is that Brobdingnagian base. That's the huge base from 2011 to today. And this is the issue. It's failed 1, 2, 3, 3 different times, and so it looks like now might be the actual time that it does work. Up 5% now this past month.
And Wes, let me make a point here. Both gold and Bitcoin have broken out, and both of them have been touted as inflation hedges. And gold's breaking out. I mean, you clearly have a buy signal long term when you look at it on the monthly, on the weekly, and the monthly on gold. But we think there's more horsepower in Bitcoin. The idea that actually I saw where Bitcoin, the ETFs, the 11 ETFs that initiated a new ETF, they exceeded all the dollars in GLD in terms of assets under management. And this has been, I mean, since they started this, and I forget when GLD began, maybe 1994, maybe. And we've exceeded the assets under management in Bitcoin in what, 2 months, a month, 2 months. I don't know exactly when when they came out, but it hasn't been very long at all. So, there's more horsepower here. And, we did sell, just from a tactical standpoint, we did sell into strength because we were up 50% in it, and we had millions of dollars in it. And so we just, we wanted to de-risk a lot of these trades, but we actually bought a little bit back today because there's a consensus on Wall Street, whether or not this happens or not, who knows, but money is chasing this, institutional money. It's a gold rush. It's chasing Bitcoin. There's a Bitcoin rush. Everybody out there is projecting price targets of, anywhere from 150,000 to 250,000 to 1 million. We have no idea what's going to happen. I mean, it remains to be seen, but, it's very close to all-time high territory and with no overhead. And if everybody's got a profit in it, that sets the stage to go significantly higher. So we just don't want to miss the breakout, and it's so volatile overnight that it came in just a little bit. We bought a little bit, and we're going to be we will be buying more if it when it hits an all-time high again, and that's Bitcoin, not gold. So just wanted to provide a little bit of information on that, little color on Bitcoin.
Thank you.
And
Okay, so one more
thing. One more thing. A travesty would be to know this and to think and be convicted. And we are convicted. We're just worried about a little short-term overzealousness in the market, a little bit of euphoria, a little bit of giddiness, where we see SMCI, NVIDIA, Bitcoin, these volatile assets spike. And that's why we personally pulled in a little bit and improved our worst case scenario. But if this market doesn't go down, we just need it to go sideways. And actually, when I'll pull up the NASDAQ and show you sort of what we're looking for, and we're comparing an analog. Wes was looking at 1995, Wes, and 1990,
pause,
1995,
right?
huh?
That when the Fed paused.
Yes, right there. And we're looking at that. And then we were also looking at coming out of the bear market in 2003, what happened at that particular time too, and how the market kind of stair-stepped. And we'll pull up the NASDAQ and I'll show that to you shortly.
Excellent. Yep. So yeah, just last one I was going to point out, just because I thought it was interesting. We've been kind of eyeballing China. So I wanted to point out there was a follow through day here in the indexes in China. I know Keith has been talking China a little bit too at Hedge Eye, just because he thinks the macroeconomic view has changed finally there, and thinks we're coming out of an industrial recession. And that industrial recession, although we didn't see one, quote unquote, see one exactly in the U.S., you did see how negative that leading economic indicator index was, which is very, very, very odd, right? To not have a recession despite that pulling in. So China's on our radar. This is good action, and you just don't want to miss it if there's a change here, perhaps. So I don't know, something we're keeping our eye on. You can wait, right? You don't have to be there early for this, but there's a follow through day, and that's part of our process here, right? In the U.S., we value and pay attention when we have follow through days. So that's something to watch.
Great, Wes. Thanks very much. Guys, let's take a 5-minute break. It's not 8:19. take a 5-minute break to get some water, use the restroom and so forth. We'll come back at 8:24, 8:25, and then we'll look at the market and I'll show you some charts that I wanted to share with you regarding where we are and leading stocks. And we'll just go through a number of these. So let's take a 5-minute break. See you in 5. By the way, do you guys see the NASDAQ on Market Surge on your screen right now?
Yeah.
Okay, great.
Yeah.
The only thing I'm kind of concerned about Bitcoin is like I was hearing everyone wants to sell it for during the tax season and then after the halving they would buy it back up. So I'm not sure if I have to buy it when it's like in the bull price.
That's an interesting concept. From the Bitcoin pundits and the experts, they expect this because of the halving, and that's where the supply is cut into two. They expect a big move. They expect a big move after the halving, and the halving, I think it's April 11th, if I'm not mistaken. And
26th, I think, or something.
April 26th.
I believe so. Yeah, every 4 years, right?
Thank you. Yeah. So April 26th. So I wouldn't use, I just wouldn't, I wouldn't get too cute around that and thinking that, people are going to be selling for tax consequences. Well, first of all, if you've had it and you haven't sold it, you've got a long-term capital gains and you may not sell it at all. So there's no way of predicting that. Or speculating who might sell it for tax purposes. You're going to hear a little bit of that rhetoric in the overall market because the market's been so strong so far this year that, you might have a little bit of tax selling. And that's why, typically you have a couple of weeks there where, where we might consolidate. But the market pullback has been so adept at keeping everything contained that there's just no way of predicting, when these sell-offs happen or, when they will happen and when they will occur. So let me go ahead and talk to you about the NASDAQ here. So here's the NASDAQ and here's the pullback that, going through today, we had this outside day to the downside, which is very bearish. You can see from that the October bottom, November 1st, all the way up. you can see how significant that look is. So you can see that outside day to the downside, which is typically a sell signal, particularly after a nice run in the market. So, you know, so we raised a great deal of cash right there, and then we put, I think, 4 positions back on today because we didn't follow through to the downside in spite of a negative and bearish and hot CPI report. For all practical purposes, this market should have been lower today. It should have followed through on the downside. And, you know, we have a pullback target of this 50-day. See, that's what we expect to happen. But it's been so strong that we've been contained by the 21-day. You can see the market is tracking this 21-day. Every time we come down to this 21-day, the market has found its footing. Now, notice these are pretty significant down days, but we seem to find our footing at the 21-day. This is a major down day here. Here's a big down day there on the NASDAQ. NASDAQ was down 286 points. That was huge. So NASDAQ was down 2%. And on that day, it wouldn't surprise me to see a lot of these growth stocks down 5 to 6, 7% during that pullback, you know, on that day. And then we had this outside day to the downside, which got our attention. And we were looking, Wes and I were looking, let me show you sort of coming out of a bear market like 2003. Let me change 11, 1, 2, 2000. Yeah. Okay. So this is very similar. See, where we just, you know, we're in this power trend, we're in this uptrend, and this is going after the 2000 to 2002 bear market. You can see the follow through day that we had right here above all the averages. This is a 1, 2, 3, 4-day follow through. This is where that power trend began. Now we're going back to over 20 years ago. So that's why this is quite, you know, useful. And then we had the move, you know, the move here higher, the pullback to the 21-day. See, we sort of think that we're right in here. You know, we're right in here where you could come back and have the first pullback to the 50-day is in fact viable. And, you know, if you get a pullback like this over, you know, subsequent days, you know, we think that that's viable. So we were hoping that we would, you know, follow through to the downside, just rip some of these stops out of the way, come down here to the 50-day and then turn. And then you had this nice move here of, you know, almost 300 NASDAQ points. So you would have that great trade there. And look, notice here, you had that nice move up, pull back to the 50-day again. Move up, pull back to the 50-day again. Let me change the date and go to 2004 to just sort of show you what transpired. And this is what transpired. See, we believe that we're in today's current environment, we're like right here, you know, right here, you know, just we're right here in this topping action where you came in. Well, actually, I'm sorry, right here we had the first pullback to the 50-day. Then the second pullback to the 50-day, another pullback to the 50-day, another pullback to the 50-day. And so if we can get this type of, you get on the right side of this trade and, you know, where you can buy here, sell here, buy here, sell here, buy here. That's what we're, you know, that's the environment that is potentially setting up for us. So it's really setting up from a swing trading perspective. That, you know, selling the strength with a number of these stocks that are blowing off to the upside and buy the pullbacks, sell the strength, sell the rip and buy the pullbacks. And so this is something that we were paying attention to. So you can see that we went from 1600 to 2200. You know, we had another 30% in the averages before the averages peaked. And, you know, if you go, you know, again, if you go up 30% in the averages, you're going, you know, growth stocks are going to go up 50, you know, 50 to 100%. They're going to be up twice what the indexes are, you know, if you get the right stocks. In other words, if we have a move like this, NVIDIA is going to be much higher than where it is right now. NVIDIA is going to go from 1,000 to 2,000 potentially on on that move up. And with that in mind, let me bring up this analog as well. Qualcomm, this is a stock that not just me, but a number of us made a fortune in back in 2000. And this is going way back. I mean, this is going way back. And this is that internet bubble from 1998 to 2000. And I want to point this out to show you, what could happen and what might happen with some of these stocks like NVIDIA or SMCI. So Qualcomm had this major move where you can see where it doubled on this move here. It doubled from here to here. It doubled from here to here, and then it went. You went into sideways action. So you went sideways. So we're looking at, like NVIDIA and SMCI, particularly those two stocks, to see, well, they've had this big move to the upside, but if they go sideways and tight, you're going to have another opportunity to buy them. And Wes and I were talking about this. And if we get a setup like this, where something's doubled, then it gets quiet and tight, but it's holding the 10-day the whole time, and then breaks out. This is the time when you throw the book at it. So, if we have a setup like this, and we'll be, if we do this, and if we do this, we'll be doing this in probably NVIDIA or SMCI or some companies that are taking off that have the power that we're looking for. But then you had this move here. See this, there's your blow off move from 100, then it goes from 100 to 200. So you can have this blow off move. This could be in Bitcoin, or it could be in SMCI or NVIDIA. But we think that you've got, that potentially this type of setup where it could get crazy. And, on the upside, and NVIDIA, let me change the date here, is certainly the one that you want. But this outside day, to the downside, sell signal. And so basically what I'm saying, that if we would just go sideways, for a couple of weeks and work off this overbought situation, and see NVIDIA went from 500 to 1,000. There's the 100% move. Consolidate. Then if you take that out, we'll own this stock back. I mean, we've got a 7% position. We had a 15% position in it. We'll own this stock back heavy above 974. See right there. So we'd like for this thing to come down and give you a better opportunity to, to add to it. Not just it ripped up here, but it's showing up 12, up 60 today, up 12. And there, we bought a little, taking out that prior day's high, that we put a little bit back on right there. So that's a potential setup that is setting up. So keep that in mind. And based on the fundamentals and what we've read about the company in terms of the reports and the demand, it's insatiable. They're dominating, and it is insatiable, the numbers that they're putting up for a huge company. And here are the estimates. See the next, this quarter, the estimates can be 459%, another major move. And then it starts to become more normal, not normal, but more blue chip, 100%, 42. But these numbers, these are huge, huge, huge numbers. So don't think when you're looking at it on the weekly and on the monthly, and we've talked about that before. Here's that green line breakout. See where it got into all-time high territory, and we're looking for a move like that. See, we're looking, from all, breaking out to all-time high to that kind of move. So we think this move here could take it significantly higher. And particularly if this AI build out lasts to the end of the year, you're going to see this stock go appreciably higher, much higher than people expect. Similarly, perhaps similarly to you know, the Tesla move, when Tesla, go back and you study Tesla, when there's, let me make sure, yeah, there's the monthly, when you had this move, the breakout on Tesla, 25 to 400. And, you know, you had this big move up there, the pullback, then you had the move here, you know, from 60 to 120. You're thinking, you know, you're thinking it's over. Then you have the next move up. But in fact, this stock peaked when it was moved into the S&P 500. And I think it was put into the S&P 500. I think there, if I'm not
I
mistaken.
think it was further right. I think it was
Right here?
2021. I think it was 2021. It was that last push up, wasn't it?
Yeah, right here, this 2 day, these 2 week, rather,
Yeah. Yeah.
monthly, 2 month.
Yeah.
Okay, could have been right there. It was very close. Let me see what the weekly looked like back then.
Actually, in 2021, the Elon Musk, he bought Bitcoin. So Bitcoin went from about 20,000 to 60,000 in that time frame, 2021.
Yeah, that's on Bitcoin. We're looking at Tesla. Do you have it when Tesla was put into the S&P 500?
You know what? December 2020. So not that last push, but that right
Here.
there. Yeah, around there. Yep.
Yeah. So right there, for all practical purposes, that's when it was moved. Now SMCI goes into the S&P 500 Friday. So you have to be careful because you had this big move, and then that was the peak for some time because everybody's in it, you know, and there's the peak. And of course it did, you know, it went sideways for a year before then it broke out and tried to, you know, to go again, but it was over. So the point being is that if you look at SMCI, there's SMCI, you had this move here, straight up, and you can see if this darn thing consolidates. Now the numbers on this stock are, you know, they're incredible. The numbers are amazing. And they, terrific numbers. $21 this year, $25 next year. And this is the setup that I'm really talking about. See where it peaked there and then came in, got really volatile, and now you have this peak. So this is going to be interesting because it goes in the S&P 500 on Friday, and you wonder, well, is that the potential? Is that the high? In the stock? And rarely does something peak that's only going up 12 weeks. Normally you have weeks of an uptrend before a stock blows off and actually, finally peaks. So that's going to be interesting to watch. So keep that in mind. So I guess what I'll do is just to get this thing rolling, I'll show you what we own. We spend a lot of time, doing our research and trying to identify these leading stocks. And we own 11 stocks. We had 19 before. And let me just share with you in terms of tactics, in terms of managing a portfolio versus trading the market. If you're a short-term trader, it makes sense just to take the 10 to 20% gains when you get them and compound it. Just go to cash, look for the next one, and do it over and over and over again. And that's how I achieved those great results in the U.S. Investment Championship in 2021 and Mark Minervini too. I think he was up 300% that year, and I was up 214%. But from a trading perspective, and on a portfolio perspective, where you want to hunker down, you want to find the stocks that can go up and you get leverage from these stocks that go up 2 and 3 fold, and you want to hold on to those as long as possible. And so that's the dilemmas that you're going to have to determine for yourself, do I want to sell in the strength where your equity curve is constantly going up? Or do you want to have your stops in and you'll always be giving up something from the top, you know, if you have a trailing stop in there, but you're in there for substantial long-term capital appreciation. You know, rarely will you get something that's something like an SMCI that doubled, in 6 weeks. Rarely does that happen. So you have to determine, am I a trader or am I a long-term investor? But this is going to be interesting to see what happens with this SMCI. But this is what we own. So we own Bitcoin, and we bought Bitcoin right there, breaking out of this VCP, and then it came up and then made another VCP. We pressed it right there. So we bought it back here. We took a loss, by the way. We had owned it. We took a loss like probably maybe this day. We reversed. It went lower 2 days later and we sold it right there, but we bought it back there. Moved up. You had a consolidation. We doubled up there, and then we sold half of our position right there. And then we bought a little bit back today. We were hoping that we'd come in here to the 10-day, which is 37.70, and we might, but this thing came in and then closed great, so we added a little bit more. So, and we'll probably buy some more if this thing doesn't consolidate and rips to new highs. We'll be pressing the position a little bit. So that's a perfectly executed, trade and investment right there, where you have significant, you make significant profits. So we bought ServiceNow today. Most of you are aware of ServiceNow. We think this is one of the top software companies on the planet, with great management. Bob does a great job leading the company. We bought it breaking the downtrend line here, and they had a great conference call. And in the conference call, the CEO said they're working on, I think, 19 AI initiatives where their clients don't even care what the price is. That their productivity is increasing so much that it's impacting their bottom line so much for their clients that they're just signing them up. And so there's your buy point. We bought it perfectly, breaking this downtrend line. And we'll see, and we'll probably add to it, taking out this 815 pivot. And if it comes in and sets up a little bit, well, that would be great too. But we wanted to get the position on breaking this downtrend line, because that might be it, from the move here to the 50-day. And they've certainly got the chops. Look at the earnings report. They're up 37%, up 46%, up 49%, 36%. See, these software companies have tremendous leverage because their margins are terrific, and that's why they're so attractive. And you can also look at this. This is in a green line breakout, all-time high territory, and this just took place. So we don't care. No one should care that, it's an $800 stock. This is an $800 stock that 7,300 that should go to 11 to 1,200. And we're interested in the percentage gains, not necessarily the price of the stock. So stock's going into new high territory, and so that's why we initiated that today. We also added Dexcom today, which I'm sure you're aware of their diabetes continuous glucose monitors. Looks great on the weekly and monthly, and they just offered, and we just bought it today on this reversal. Look at this cup and handle. See, look at this cup. There's your handle, and you had a perfect cup and handle breakout on this stock today. And they announced that they were offering their monitors to people that have type 2 diabetes, that you're not using insulin. And so that opens up a massive addressable market. So there it is. There's your cup and handle. There's the perfect entry. What got our attention was this volume right here, the largest volume in the base that it's experienced, since it's been in the base, and that's up volume, the consolidation in a couple of days, and it should be off to the races from right here. See, perfect cup and handle. And you're buying it before this 139.55. So you're getting it a little bit early, buying it, right here in the handle. Great numbers there. Uber, everyone's aware of Uber. And this is
Roy.
one. Yeah.
Hey, Roy, it's Amit. On Dexcom, they also announced that their continuous glucose monitors would be available over the counter. So that will drive a much higher volume.
No, I've been diagnosed with pre-diabetes, and I sort of looked into it a little bit today. I think it's pretty expensive, Amit, and well, I'm not exactly sure, but I thought there was a monthly charge for that, and I'm not sure. And I'm actually going to the doctor tomorrow for a checkup, so I'll find out about it. But that would be interesting if your insurance pays for it. And I don't know what the benefit of having the monitor on if you're not taking insulin. I'm not exactly sure. I need to get more educated.
Well, I tried it, Roy. The benefit is it gives you a reading every 5 minutes.
Yeah.
And I think the ones that they are going to put over the counter is going to be 10 or 15 minutes.
Okay.
But imagine instead of, you measuring it twice a day or something like that, if you get readings every 5 or 15 minutes, it just shows you, how things change. So you may not have to do it permanently, but if you use it for a month or two, you get all those patterns.
And that's going to be that's going to point out your blood sugar levels, correct? Is that right,
Correct.
Amit?
Yes.
Okay. Well, this stock got wiped out because of the weight loss drugs, and that's what happened here. And this stock has terrific earnings. They are the leader. They've made money forever. And it's a blue chip stock, and we hopped on board on it today because this screen with that volume accumulation and the idea that it consolidated, came down, went green today. That's why we bought this one. And Uber, I think we were in Uber maybe from here. We averaged up, and then Wes, did we sell any Uber the other day, or did we hold all our position?
We did not sell any.
Okay. So, you had there's that outside day on the market, but it's holding this 21 days. So this is the dilemma. You have to look and see, well, for a new position. Now you can see 1, 2, 3, 4. This is 5 weeks tight. I mean, not exactly, but it's pretty tight in the closing prices. And normally you want to see, when you hear about a 2-week tight or 3-week tight, you want to see a close within 1.5% each week on that. And so you have from this close right there to that close, it's probably more than 1.5%, but you can see the last 2 weeks, it's real tight right there. So this is the setup I think that the market is going to provide you with. And it's not, you're way past, low risk buying it here, low risk buying it there on that breakout. Now, it's, there's obviously more risk, but we think that this has got another leg up. And so we're looking at, if you don't own this, it certainly makes sense right here at the 21 day, to buy a little bit of the 21 day. You can, from a short-term perspective, you could use yesterday's low for a stop for sure, but buy it here and then press it there at 81.86 And there's the setup there. You can see the numbers up 128% in earnings. They had a great quarter, and the stock gapped up on the quarter. The cash flow is great. They're dominant in what they do. I think they're the world's largest employer, and there's the setup. So this is one of those true market leaders that we think is going to last for multiple quarters. You know, it's going to go up for multiple quarters. And so that's what we're trying to do. Hold on to something like this, and get a 2 to 3 bagger out of it. DraftKings, there's great quarters. The earnings were up 300%, revenues up 44%. And, the two players in that field are FanDuel and DraftKings. And this is not doing anything wrong. Look at it consolidating. See, when you have SMCI and NVIDIA all bouncing around, these stocks are just very quiet. And that's what you're looking for. You're looking for low volatility, for this volatility to contract, as it consolidates. You can see where volume is declining. And so you've got a nice setup. You do have a pivot right there at 45.62. So, if I'm trading this particular stock, which, we own it, I'd buy a little bit here and then add through this 45.62. Or you could buy a bigger position right here and use yesterday's low for a stop. That's another way of handling it. Okay, the next Palantir. Let me see, all-time highs. Yeah, so the real money, see, this is the green line breakout way up here at 75. The real big money can be made when it gets over 75 and goes to, 150. It's not right here. It's got its work cut out to come back and make new highs the way like IoT, which we bought today. And there's, when you look at this IoT, see where it came all the way back and made new highs, consolidated, and then followed through on that IoT, which is, it's interesting. I know Amy's on the call here. I'm interested in talking to James about XPO and if they're doing any business. Actually, they're doing business with Samsara, actually. And Amy, I'll give you a call on that probably tomorrow. And so this is this IoT, and notice this, look at the reaction to earnings. See, this is what you want to see. And the earnings reaction 2 days ago, earnings were up 300%. Earnings reaction right here, stocks up big. Earnings reaction here, stocks up big onto the earnings report. I don't think I've ever seen, Wes and I were talking about this. This stock is gapped up 1, 2, 3, 4, the last 5 earnings quarters. And actually it gapped up down here. It gapped up there. And so it's showing you tremendous institutional demand and, tremendous institutional demand. And, but, if you bought this stock on the earnings reports, you got shaken out all these times, many times. So we're hoping that this is the breakout that sticks and it's just straight up from here. And what gives us confidence on this, guys, it's at the green line breakouts. It is in all-time high territory. So we added this stock today. There's the earnings report. Great earnings report here. Big institutional buying right here. Big institutional buying there. This is a perfect setup. Don't know if it's going to work. And of course, it's not. We're not giving you advice, but we did buy this stock today. We're high on it.
And Roy, quick question there. When you start this position, is it 2.5%?
5.
No,
So,
not anymore. We started. Well,
go ahead,
I was just gonna say, yeah, we were doing 2.5% positions in like 22 and 23 because it was a lot harder to gain traction. Now we don't want to waste time with a small position like 2.5%.
we want to move the needle. So, Jonathan, we want to move the needle. For you to move the needle, we want a big position. We started offering a swing trading product where we're swing trading most of the same stocks that we're buying from a long-term account. but we're a lot quicker to take our profit, and we're a lot quicker to take our losses as well. But Wes and I are going to talk about this, but from a swing trading perspective, right there, I'm going to 10%, like right there at 40.55. So, you want to press, you want to get as big as you can, as quickly as you can. So if we follow through and take this pivot out right there, we're going to 10% in the swing trading account. And Wes and I will talk about doing that in our long-term accounts as well.
So,
But
so Roy,
that's just that. Yeah, go ahead, Amit.
so Roy, in the swing trading account, if you take a 10% position, how would you mitigate the risk if it gives back?
I'll just have a bigger loss. But if we take a 10% position right there, we're going to use this as our stop, 37.57. If we take a 10% position and we're pressing it right there, our stop is going to be right there, Amit. Right there. So it's a 1-bar stop. So it's got to go through and to break into this new Darvis box. And then we're going to use the bottom of this pullback as our stop, which is going to be
7%.
41. How much?
7% just measured here real quick.
Okay, 7%. Thank you.
Ish. Yeah.
Yeah, right there.
Thank you.
And I'll let Wes take the floor on Palantir since he's a big Alex Karp fan.
Sure.
Wes,
Yeah, no, I am a fan. Yeah, I'm a fanboy. Shoot, I don't know. I like what they're doing. I don't know if my fundamental view is, well, I like what they're doing, and it's set up. It broke out. I mean, it's not at all-time highs yet, but you see the positive response to earnings, and they're just growing customers like crazy. And they've had these AIP cons. They've had 3 AIP cons where they're displaying how much they're doing for all these customers. And if you have time, go ahead, check them out on YouTube, the replays, and you can see it's tons and tons of customers. And they've done like 800 of these boot camps, which is helping to get people on the platform, and they're doing it in a matter of hours. And they're really streamlining getting these people on board and doing actionable things. And in my opinion, you can see that day where it followed through beyond that 25.52, that big up day 5 days ago. Some people attributed it to that Titan, this Army contract they won, but to me, I think it was more related to this AIP con where it was oversubscribed for the third AIP con in a year and a half. And they talked about unveiling more new customers. And I don't know, it's hated by Wall Street, which I like. Alex Karp's an extremely eccentric kind of leader, and real motivated, just not by anything other than their mission, the company's mission itself, which is to be the most important software company in the world. So I don't know. There's a lot of interesting things about it. That's why I'm high on it, just because it's hard to you can't. There's not a lot of leaders out there that are of that caliber, like I think like him, that's extremely motivated to succeed for things outside just money and the success of the business. He really believes in this stuff. So and yet, man, am I concerned about the recent price action? Sure. This has been a tricky one to trade. It's really held by a lot of retailers, honestly, and not as many institutions. But in my opinion, you're going to see the street stay wrong on it, just like the street was wrong on Tesla for many years. And they're creating a new category of business in general, right? It's a completely new category of things that they're trying to do for people, just like Tesla. And they were hated by Wall Street. Everyone had a sell rating on them. Everyone has a sell rating on Palantir, except for maybe 2 people. And so that's just going to bring more and more institutions into the investment pool.
Are you concerned about the overhead supply?
well, just
A little, but
yeah, go ahead.
well, I mean, you can go if you would like, but I was going to say, we own Crowd too, and we weren't exactly concerned about crowd oversupply, because this stuff you can work through it quickly. And I'm glad we didn't worry about the oversupply on crowd, because look at the move, right? That we got in early enough, and now we're free and clear of that overhead supply. So in my opinion, it's just it's overwhelming demand for this product, which is interesting, and that's just uncommon. And so I think they're going to get through that overhead supply, and that's when I think it gets easier. I think you're probably contending with some of that right now with these sharp pullbacks, like you see there the last 3 days.
And we bought it, after earnings, the day after earnings, and notice, see, I think we tried this a number of times. We probably bought it,
Yeah.
in here and got stopped out. We bought it probably on this breakout thinking, okay, now it's going,
Yeah.
got stopped out. This time we bought it day 2. We bought it exactly that day right there where it took out the prior day high. We bought it right there and we pressed it right there. So we bought it here, we averaged up here, and then in the trading account, I went to cash 3 days ago, like right, I think here, and then I bought a 5% position back here today. That if it takes out today's high and reverses, and it's going your way, so it's a little bit of a risk, but we're right at the danger point at the 21-day where it should hold and turn up. And if not, we'll probably, from a trading perspective, if it takes that out and breaks the 21-day, we're probably out. That's how you would handle it. But it's right here. It's come in 3 days. If this stock bottoms and turns up, you can get more aggressive on it, I believe, as well, taking this high out. And then now it's trading back in your direction again. So that's the way that we would handle that. Make my trip. Yeah, go ahead. Questions?
Do you guys tend to take your losses at around 6-7%, kind of like, or 7-8, like the O'Neill type of thing, or short of like 3-4%?
Yeah, we do. Yep.
And 3-5 is too tight, type of thing.
It just depends on how close can you get for it to turn, and are you adding to it? What's your how much profit? Do you have a profit, first of all? When you were saying we're going to take 7 or 8%, that's typically a max number that we take. Certainly now with the market is improving, we're not. I look at it from a standpoint. We're not going to risk more than 1% of your capital, of your whole capital on the trade. And so you can make that math work, whatever you're comfortable with. But Minervini has often said that he's risking anywhere from 1 to 2 to 2.5%. So if I risk 2.5% of my total equity on one trade is too much. But you just have to make the math work. I don't want to lose 2.5% on in equity on one trade. But I try to keep it 1%. So I think I had maybe only 2 or 3 times last year, only 3 times in the whole year where I actually lost 1%, and they were gap downs. There were gap downs pre-announcements or an earnings report or something like that. That it was down 20%, and I had a 5% position or something like that. Going into a number. So this MMYT next, and we just have a couple more of these. Earnings were 150%. And again, the trend that we're trying to talk to you guys about, and we have consistently done this, is when these stocks get into new high territory, particularly like when they're IPOs. And look at this base. Look, 2001. This is a 10-year base. I mean, gee whiz, a 10-year base that breaks out, that's growing like this. 150%, 257%, 500%, 163%. So I don't know what's going on, in India, but the Indian stock exchange has been, on fire, and this is one of the leading stocks that trades here, You know, of course, that's an Indian stock, but we're in this stock. We have a nice position in this stock. Earnings and revenues are going great. And, look at the stock with all the commotion that took place last week. This thing stayed above the 10-day the whole time. And a little bit of pressure comes off, and look at the stock start to move, going into new high territory again. No overhead. And, that's what makes it so attractive. So there's NVIDIA. We've talked about NVIDIA. ARM, which was, ARM was, this wasn't an IPO. This was, it was public for years and years and years. They brought it private, and then they brought it back out right here. So this wasn't like a brand new IPO. It was an IPO that was private, but it wasn't like they've been public before. And we're up. We bought this stock perfectly we bought it there at 65. We averaged up at 68, and we sold half right there, up 93%. So we sold half, and we're looking at and we bought a little bit back that we sold a couple of days ago. And you have this powerful move on the upside. And if you do some fundamental work on ARM, they are in everything. NVIDIA owns a big part of the company. NVIDIA tried to buy them a few years ago, but it was not approved because of antitrust. And, semiconductor stock, and look at this is what got our attention. This stock traded 111 million shares on the earnings report right there. It can't get any more bullish than that. So that's what got our attention. And, we want to, we're going to buy more of this breaking the downtrend line if, in fact, that happens. And I bought it in our swing trading account today on the move down, the move up, and we'll probably use a stop at today's low. See where it's reversing from a trading perspective right there. But you have really solid numbers. They're in everything.
The lockup,
Yeah, go ahead.
I'm sorry, the lockup has expired. Is that anything to be careful about?
Yeah,
it's today.
look, the only reason we didn't buy more today is we're afraid they're going to dump a secondary on you, like tonight. And it didn't happen when the lockup expired. And, if they don't announce a secondary, this thing, it's going to move higher quickly. But there's the lockup. So if you take a look at the next stock, Kava, you can see what happened with their lockup. This is the lockup right there. This is when Kava's lockup expired right there. And it went straight up when the lockup expired. And, this is one, and we bought this Kava exactly right. We bought it we bought this Kava right there. And I think we pressed it right there. And so, so you came back, it broke out to an all-time high. This is that turbulent zone that the life cycle folks talk about, where a stock comes all the way back and makes new highs. See, again, my point being that I've shared with you before, the real money, it's not from here to here. The real money is when it gets into all-time high territory, the next move. And so, we're growth investors. We don't care what the PE is. We care about the price action, the growth, the revenue growth. So we're not concerned about valuation at all. And we're just looking at the action. And there it is on this, there's that signal that we keep alluding to, that green line breakout. And notice, if you would have, that green line breakout on SMCI was right there. And, who would have known that this was the biggest performing stock going to be the biggest performing stock out there, over this 8-week period of time. But there's that green line breakout, and it happened at all-time highs. So that's why we're so, we're so interested. See, the big money, it wasn't on CrowdStrike from there to there. It's going to be the next move, we think. So this is, of course, the leading security company out there. I was talking to Amit about this, and we do like OKTA, and and also NET, that's that's in that area.
So listening to it, but whatever.
Yeah, what's that, Rob?
Okay.
Yeah, what was your comment?
It's like mildly interesting.
But anyway, there's. Did you have a comment? I can't hear you. So here's the setup on. Here's a setup on Cloudflare. The move to new highs, the pullback. Now, look, guys, keep this in mind. So this is really the type of setup that I think works best in bull markets. Those stocks that power ahead on the report and then they pull back, but a stock that pulls back all the way into the base, that's not as strong as I'll show you a few of these stronger companies. So this had great action, but they sold right into it. So you don't have quite the accumulation, that some of these others have. They sold into this a little bit too much. It's holding the 21-day, but that is a weaker stock than, for example, you take a look at a few like that have hit recently, BWXT. See your breakout here on volume, and then the pullback is the 10-day is higher, see, than the breakout level. See the difference between this chart and NET. This is a stronger chart. See where this has come back. VERX. See the breakout here on volume. That's a great breakout, but the idea that it came all the way back in, this is not as strong as that BWXT. AV, and this is, these powerful moves off earnings. This is what certainly we're keen on. I mean, every situation like this is a little better because, the 10-day, again, it's above that Bible gap low on that day right there. And, AV, they make drones. And so there was great guidance. They do a lot of business in the, of course, for the military and the war there. So, guidance is good. So you have the pullback here. So this is a nice little setup here that in earnings and the volume targeted, pinpointed, the stock. APP. If that comes up. There's earnings. Look how nice this is held into the report. There's the earnings report. So what we're doing is we're going through all these earnings reports and we're identifying this pattern. Now, this is what we want to own, with no overhead. Where's the overhead on APP? Yeah, see, there's overhead here, but it's one of these IPOs. See, the IPOs that got crushed, these are the ones that have tremendous growth prospects and the numbers are there. And these are the ones that we think are going to drive the market higher the second half of the year. And so, the breadth is going to improve. You're going to have companies like this making all-time highs. And, these are going to perform for you. Square, this is interesting. Yeah.
Well, quick question. Sorry. So are you saying that you don't like or you do like crowd's reaction to the earnings report?
CrowdStrike,
Yeah.
I don't, we didn't say, we bought, we didn't, Wes, we didn't sell any of CrowdStrike, did we? Right there?
We sold ahead of it, like 2 days ahead of that, right
Okay.
before the 50-day visit. So like I think right there.
Oh, yeah. Yeah,
And,
okay,
yeah,
so
then we bought it. We may have bought it on the earnings day at like 3:25 or something.
we bought it that day when it came all the way in, thinking that, okay, that's the earnings report. We bought it
3:30, probably 3:30-ish.
Yeah, 3:30 right there. So it reacted great. And, we think this is the leader and we think they had a great quarter. The group's been under pressure. Palo Alto, FTNT, Cyber, a lot of these have been under pressure. And, but we think CrowdStrike, the numbers are the best. They do have the best numbers and they gave the best guidance as well. So this is sort of a little hiccup. So we sold half of it. We didn't want to risk it dropping 20% like Palo Alto did. There's Palo Alto that got hammered on the number. And then, you had no idea. Palo Alto, leading institutional stock and, one of the leading security companies. And then it just got crushed down 28% on the number. And so so we dodged that. We didn't own it going into the number, but we did sell half of our CrowdStrike because, we didn't know if you wouldn't get a 20% drop, in it. And we also bought, I don't have Lilly. We bought Lilly back. LLY. We actually owned NVO and Lilly, and we sold too early. We sold right after the earnings report, and it was kind of this action right there was perplexing to us. So we had this stock. We bought it right here, breaking the downtrend line. Perfect buy. Of course, Lilly's got Moderno and Zepbound. That's Tarzupatide or something like that. Tarzupatide, Taripazide, something like that. I forget what the generic version is, but we sold it. We thought we sold it looking back prematurely. We did buy it back today. You can see on the turn here because Moderno and Zepbound, they're going to be $3 billion. Let me see. They're going to be doing $3 billion a month 5 years from now. That's the projected numbers. I mean, the numbers are just astronomical. And there's so many people on Ozempic, and Ozempic is manufactured by Novo Nordisk, along with Wegovy. That's their weight loss. And so we bought, we don't know if you can get rich overnight in this, but we think this stock is going to that's going to be the best-selling drug of all time, other than there's a cancer drug out there that I forget who it was that AbbVie owns, ABBV. But I actually Googled this to see what's the all-time biggest drugs of all time. And Moderno is there. And Moderno is, from the reports that I read, it's like it has been 3 times more effective than Ozempic. But you hear a lot of stuff about Ozempic. I think Norvo did a better job marketing it, but Lilly's a bigger drug. Lilly's selling a lot more Moderno and Zepbound than Norvo is, but Norvo has a better chart. And look, I mean, Norvo looks great. And again, there's cardiovascular benefits for both of these drugs. And what put a little bit of what dampened the outlook on both those drugs. VKTX Viking came out and said their drug, it was only phase 2, was more effective than both Ozempic and Mounjaro. And so the stock, how much did the stock go up? Stock went up 121% in a day. And now it's come back down, and legitimately it should be down here because they have they've got several more years before they could even take this drug public, before they have, their phase 3 trials. But somebody's gonna buy this company, but you can't buy the stock just for the buyout purposes. You can see no numbers, but they had a great result. But this is down the road, a couple of years, and so we would rather buy something that has the numbers right now, and that's NVO and Lilly. Both of these we think are must own. And this is really not a trade. It's for, okay, 764. If I can make, if this thing goes to 1,000, by the end of the year, and you've got a 10% position, and you make 2 to 3%, 2 to 3% on the whole portfolio, that would be additive. And that's what we're trying to accomplish. It's different than trying to have a 10 or 15% position in Bitcoin or NVIDIA, where we think they could potentially double. This stock, literally, there's no way this stock is going to double. It's almost $1 trillion company. It's not going to double in in 8 months. There are too many moving parts. It's too big of a company.
Roy, with the addition of the forecast numbers in Market Smith and on the weekly chart, the fundamentals, earnings, yes, and sales growth projection, how far in the future do you consider those numbers, and how much of the price that we see today is considering those?
Well,
how you balance that? How you in your analysis?
Yeah, you don't know. You don't know you have no idea what the numbers are going to be. Wes was he's a CFA by his first trade, so he worked on Wall Street for 7 years. So he could tell you a little bit better about that. But none of these analysts have any clue to where any of these stocks are going to be a year from now. Wes, do you want to comment on, about the next 4 quarters of earnings and your take on it?
Yeah, I think that some analysts could do a good job 1 to 2 years, and that's about as far as you can reasonably even guess. 2 years out, I'd say you start to lose any bit of accuracy. When I did trucking, I thought we did a very good job in the current year. And then the second year was really difficult in cyclical stocks because you're kind of guessing if there's a peak or a bottom in pricing and stuff like that. So then, if you're in cyclical stocks, it's really, really hard. But anyways, I think 12 to 24 months is the best you can do. And then the rest, who knows? There's too many variables.
Okay, guys, how would you interpret looking at the new line on Market Surge on the weekly, the EPS line, right?
Yeah.
Yeah. So for instance, if we go with what Jim Rappel says, he holds 4 to 6 to 8 quarters, right?
Yeah.
And if we look at Eli Lilly here or Nvidia, and let's say we want to hold 4 to 6 quarters. So with this little hashtag right there on the Eli Lilly that we're looking at, could this be the first quarter and it could potentially hold for the next 4? And maybe with Nvidia, we already went through 3 big ones, 3 big earnings, right? Beat and raise earnings, right? And we might have another 2 or 3. How would you interpret that with this new line here going forward?
So this is new. So this is a new feature that Market Surge just implemented. Now, each tick mark is the last 4 trailing quarters. Like here, this is the last 4. That's my understanding. is that's the last 4 trailing quarters. You
Yeah.
can see back here where earnings were minus 95%. See right down here?
Yeah.
And, back there, from there, but it's the last 4 quarters. That's my understanding. So normally you want this nice uptrend, in the earnings numbers, but, this is just, it's really anecdotal. O'Neill never really used the future numbers, but you're looking at the past numbers when these ticks here. This is the last 4 quarters, last 4 quarters, last 4 quarters, and then the green line is superimposed on top of that. It's a trend fitting model. So
Can you pull up the video
Hey,
though, and then
Roy.
also, like,
Sorry.
well, like we were talking about, because I see what you're saying, right? 1, 2, 3, right? For the video right
Yeah,
there.
it started sloping up 3 quarters back, basically. So do we kind of have another 2, 3? And we could be looking at topping at that point.
We don't know, right? Obviously,
Yeah.
unclear how big this is. But I hear what you're saying, and I can't answer, but I can tell you what I think a really interesting thing we looked at was Zoom, and I think this is really, really, really telling, right? And so you're right to consider that, absolutely, right? We don't know if we're going to peak for NVIDIA like in 2 quarters, 3 quarters, 8 quarters, but it's definitely, you're right, something to keep in mind, because the stock's going to peak, then you're going to see, the growth slow or disappear, perhaps turn negative, well after the stock peak. So you almost have to ignore the earnings trajectory when you start, when you're trading these things, and just exit on something like these parabolic moves. And that's what we're looking for. That's what Zoom did. That's what we talked about with Tesla, earlier in this. And then what we think could happen with NVIDIA too, right? It could have a huge move and be largely over in 3 to 6 months. It's possible.
See, notice this, and when Wes and I were talking about this, see, the stock is going to peak before the earnings peak. See, right here it went higher and higher, but the stock peaked way back here. And when the earnings peaked, like here, look where the stock was. The stock was way down here. So the stock peaks before the earnings peak. And that's what happened with Teledoc. That's what happened with Zoom. Will that happen with, will that happen with NVIDIA or not? Will it happen with SMCI? That's the risk.
Hey,
But
Roy,
the stock, numbers went higher, but the stock peaked before the numbers peaked.
Roy, I got a couple of things to say.
Yes, go ahead.
Okay, could you just pull up now, please, for a second?
Yes, go ahead.
Okay, we look at the 24 estimate. Since we are on estimates, you see that's a negative number?
Yes.
That's a wrong number. Okay, just so that everyone should know, because I'm in touch with them. I also subscribe to Zacks.
Yeah.
And I know that 24 number is wrong. The 24 EPS is actually supposed to be 13, and 25 is 16 or 17. So,
Really?
Yes.
Okay.
Yeah. And the people at IBD, at MarketSmith, they're aware of this problem, and they're working on it, just so that you know. And I can send you the correspondence if you want.
Yeah.
But across the board, I found this to be the case in about 25 or 30% of the stocks I was looking at, and I didn't have a list to share with them, but they admitted that yes, a lot of NASDAQ stocks are off. And they said, we're going to launch market surge, and this is the next thing on our agenda to repair, okay? Because they're aware of this problem. So it's very much there. Now, in the context of how far in the future you should look, Minervini just looks at 1 quarter. Now, I don't know whether that's true, whether that's the right or wrong thing to do. Zanger doesn't look at the future at all. I think looking at the future helps based on experience.
I agree.
It's a gray area. All right.
Yeah. And go ahead. Go ahead.
Okay. So now a couple of questions. You're big on true market leaders, and correctly so.
Yeah.
right? And you basically are concentrating on growth stocks. And you at the last meeting, we were discussing NVIDIA. You said hold through earnings. And if you're buying out of the base, then you've got a good cushion. The important thing is to have a good cushion, correct? Because if you have a good cushion and you have protection, then you can
Yeah.
stay in it longer, correct?
Yep.
Okay. And today you've discussed selling into strength, which is also correct. But the question is, what if the market turns down as it did in 22? And let's look at now. Since we are on now, you see in 22, look at the drop. This stock went down. It lost a lot of money. So you can play the game of selling into strength. My question to you is, given your experience, what do you do when the market goes down? Because you're not going to be able to selling into strength. You can miss, right? As you well know. The truth is the trend is exists as long as it's up, and then one day it goes down. How do you handle this situation? That's my question to you.
Okay, so since that November bottom and we went, we put all of our positions on, what our modus operandi was to hold as many stocks as we can into the number as long as the market was responding positively at that particular time. Okay, now Mark's a good friend of ours, and Mark never looks at the fundamentals. So he doesn't look at fundamentals at all. And you're right, Zanger doesn't either. Zanger's looking for highly liquid growth stocks, tech stocks. So that's how Zanger approaches things. And he doesn't do any fundamental work at all, zero. But Mark doesn't really. Mark, he's got a cursory look. I mean, he pulls up the chart, but he's not buying anything based on ServiceNow's future numbers or NVIDIA's numbers or anything like that. He doesn't do any of that. And I can feel like I can speak for him because I know his approach so well. But what we did, and let me just show you some things that we got wrong. What can happen to you? So we had profits built up, but we held these stocks into the numbers, and Wes called them broken eggs. And these are stocks so we had big profits going into, I'm going to show you 5 stocks.
Yeah.
So going into Shopify, and we expected, Amazon had a good report. So we expected Shopify to have a good report. It didn't. And so we held half of our position in Shopify. No, we had the whole position. And we sold it. So we kicked the whole thing out right there, that day right there. It didn't have the response, but we ended up making 20% because we bought it like way back here.
Mm-hmm.
But we just gave up we gave up a significant amount of profits, but we were up 40% in it. Pens, we expected pens to be good. Look at this. Look at where we bought pens here. And then this nice base, and it's breaking out again, ready to go there. We held this into the number, and it got trounced during the number, another broken egg. And we bought it here, so we had a 20% profit in this after we sold it. And so we held the whole position because everything's been working for us. But that didn't work. GTLB, we certainly expected this to have a good report going into the number, and we sold half the day before, right? We did sell half because we had recently we had some bad experience with Shopify, Pens, Melly, and ESTC. So we sold half here, and we sold the rest that day, another broken egg. But we expected this stock to have great numbers, and they just didn't have a good report. And then ESTC, this was, again, Ropel, this was his top pick for the year. And we owned this, and we bought it on this Bible gap up. So we, on this rope, on this stock here, the breakout on volume, it got us into the position. I think, we bought it here. We bought it on the pullback here. I'm not exactly sure, but we, the day before the numbers, ready to go, and we were going to press it. Like we were planning, if we had another move like this, we were going to double our position in it and get heavy. It went the other way, broken egg. And the last one that we got hit on, and what's fortunate for us, we just gave up profits. See, this is Melee. Melee, look at the quarter earnings up 180%, 112%, 205% way down here. Great numbers. And we were going to double up on Melee. Like, look at this. It's about to break out on the earnings report, and you got, turned into a broken egg. But we had profits. These are 5 stocks that we let profits get away. If, Minervini, it's a coin flip for him, holding into the number or not. Sometimes he does, sometimes he doesn't. Depends on what the market environment is like, and have you had a series of, positive outcomes. So that's what you would, typically look like, look at. But the action the day before, because of Reg D, you never know what this quarter is going to be. See, right here, it looked before the quarter that day, man, it looked perfect. These stocks look perfect, and then they weren't perfect. So you just don't know. MRVL, that's the earnings where it blew up right there after earnings. So it depends on, do you have, how have they been working for you? Do you have profits built up? Can you, what happens if it, can you survive if it goes down 20%? Those are some things that you should look at. Duolingo, another one. Where's earnings? No, it just broke like here without earnings, right back here.
Okay.
Oh, AXON that's hitting the screens, of course. This is Taser. Look at, this is a really, really nice chart. And, if you do some fundamental work on Taser, you can see, by the way, Taser is Amazon's AWS biggest client. So they store more video on Amazon's cloud than any other customer. And, and so, of course, with Taser, since they're into the, into the cameras, surveillance cameras and all that, as well as guns, that's reoccurring revenue. And, this stock, looks great here. So this is obviously a very blue chip, company that's going to survive, that their moat is unassailable. So, that's the earnings report getting quiet. So this is this stock looks fantastic.
Exxon also bought a drone company in France.
Who?
Exxon.
Oh, did they?
Yes.
Really?
Just last month.
Wow. Okay. So that sort of opens up a new product line, does it not? Wow.
Yes, it does. Yes, it does. And that's
Yeah.
their specialty, is recording the events.
Wow. So that's very interesting. Very interesting.
Hey, Roy, but coming
just to
back to
add-
market turndowns, and how do you handle the market leaders during those times?
Just batten down the hatches, or raise your stops. Like, we didn't want to give too much up, and we didn't want to give, knowing that what's possible in terms of a pullback, we didn't want to give up like half of our profits. And there are only 2 ways of doing that. First of all, not have a stop pull back, or sell into the strength. So it's a little bit how you feel. Like, we sold we sold 60% of our holdings last Friday, because we didn't want to draw down. Like, we thought that the market was a little bit giddy, and we wanted to protect with what we had. So it was there was nothing scientific about it. It's like, okay, we've had this nice move here. We know how this, we know there's a confluence of indicators that where a lot of people are very giddy. You were seeing some things, bullishness that's, we think, over the top. That's why we locked in some of those things. But then when we see the strength today, like it made us like change our view like immediately. We expected the market to sell off today. But we got a bad CPI number and the market did not sell out.
My take on that was NVIDIA was so overbought, it got sold into, and that's why the market tanked. It's all algos anyway, right?
There's a
NVIDIA
lot
was
a lot of algos.
NVIDIA was at an extreme, and that's what caused the whole thing. And that's why now the overbought is relieved and everything's come back. That's all there is to it.
I think SMCI even more than NVIDIA, but because of the move there. But NVIDIA is certainly more widely owned, right? More widely owned. This is the leading stock here, and I mean this would not surprise me. I remember coming out months ago, like 4 or 5 months ago, saying that this is $1,000 stock. And now I'm beginning to think that, man, with the runway ahead, man, this could be a $2,000 to $3,000 stock a year and a half from now.
Okay, now coming back to the 20-30% surge that you're seeing by the end of the year, that would be post a pullback, correct? That's your thinking.
That's from like right here, here.
Yeah.
Yeah, there's not necessarily a pullback either, like we showed, earlier with those pullbacks in a really low volatility year. It's not like we might go through this with a 5% pullback max.
Yeah. So, and in terms of risk management, you mentioned 1% per position, correct?
1% of, so 1% of your capital.
Correct. On one position or all the positions you place?
One position.
Okay, so if you place 5, you're risking 5% of the total?
No, I mean, it depends on how many positions you have and what's the size. But we don't want to risk more than 1% of our capital per position. Of the entire capital. No, that's capital, not
per position.
Not the gains. That's our capital. We don't want to lose more than 1% of capital.
Irrespective of how many positions you place, correct?
Yeah, and yes.
Okay,
yep.
So yeah, okay.
So basically, if you have 5 positions, would that be 5% on the portfolio and
1%?
10%, or 10 positions, 10% on the portfolio risk, or?
Well, I mean, if you have, if you have $1 million, 10% is 100. So we don't want to risk more than 10 grand on that trade. If we had $1 million in it on that one trade, if we have 100,000, 100,000, we don't want to lose more than $1,000, on that trade. 1% of your capital on that trade.
Right. Yeah. And speaking of algos, like intraday, I mean, the intraday volatility now in 2024 is being crazy. I know we see those drops within a few minutes. Literally, sometimes I look at the 5-minute bar and I see a drop of like 0.4 or like a quarter, like a 0.5%. And probably that's algos. But based on your experience, like you've multi-decade experience, have you seen that before? Such high volatility intraday on the indexes, or is that something new for 2024?
It's new over the past few years.
Yeah,
the past few years, not just like right now, but this has been going on since they went to the decimal from a spread of 1/8 of a point to to pennies between the bid and the ask. So that's program trading, algorithmic trading.
Yeah.
Very tight, and the computers are going from one side to the other side. I guess what might give you a little bit of edge is if you want to look up the average trading range for the stock, and and those are some sort of ways to get into a position like this. SMCI, the average trading range was, I think, like $85, $90 recently. And so, if it's down, if the darn thing's down $80, you can take a guess, and at the bottom, from a day trading perspective to initiate a position. That's how some people use it. With the average trading range and also the VWAP. Some people use that, but
Yeah,
we're
exactly
aware
what
of
you
it.
said.
Don't use it.
7% or $87. I'm looking here is the average ATR.
What
And
is it?
and the
87?
ADR is the same. Yeah.
Okay.
$87 and the ADR is like $97, like $100 or 8% or so. So
What's NVIDIA? What's right now the average trading range?
let me look real quick. All right, it says like about 4% or $35.
Okay.
Both ATR and ADR.
Yeah.
Roy, I have one question about, so all these companies which burn down on earnings, like Mali, Elastic, GitLab, if you look at, they all reported like really good earnings, and they have very sticky kind of a business. So do you ever consider like fundamental part, okay, like this, and if you look at last quarter, all these companies were gapped up. I don't know like if earning were really great or it was average earning, but they were all gapped up. Is it based on your experience? Is it some kind of a pattern? Like one quarter they always report, they always gapped up, and the second quarter it down. And do you prefer to sell sell it uh, on gap down and then wait, or do you want to hold for some time? Okay, let me wait for another quarter here and maybe.
Gap downs, we hit the exit button immediately. I mean, that day, we wait to see if it'll, all these stocks that I mentioned before, we were waiting like the first hour, hour and a half to see if they bounced. But if they don't any gap downs, we're out. We only want to buy gap ups. Like the gap ups get us in, and in a strong market, and like Minervini and and Mark Ritchie and Brandon, those guys never ever buy gap ups. But in my experience, as well as Ropel, our biggest winners have come when we bought on a Bible gap up and it turned into something big. And so, but you have to have, so the market environment's got to be right. In a bad environment, the breakouts fail. All these setups fail, but we're in a new bull market, so they're not all failing. A few are that have disappointing results, but I've taken you through a number of these that have showed you that, okay, these are the leaders like right now. These are the ones you should be holding, right now that reacted good to the number. And, there's Celsius, of course, and there's the earnings report. It was down 3, went green, and, now it's extended. There's the earnings report that day. And this is one that we never could understand. Why isn't this stock at all-time highs based on these numbers? We know, the numbers are incredible. Why is the stock not reacting? And finally, it reacted right there. There was a big short interest. They had to cover right there, went higher, and and the ball game changes now.
One of the ways you can handle earnings, especially if you have a big position, say 10%, and you have a very good sizable cushion on it, like say 50 to 80%, and you don't know how the earnings are going to come down. Like, you're expecting good, but it could be a gap down and you could lose 20, 30%. Then one of the ways you can handle that is by buying put options around 2 to 3 weeks before earnings. And mostly 90 days out. So that way, if it gaps down, that's great. You can sell and get whatever you paid for. Essentially, you won't be having a 20% loss at that point because you're buying at the money put. But if it gaps up, then you can actually sell the put option and get back some of that money. You won't get everything for the put option, but some of it. But that would be a good way to hedge that position.
Great thought. You're exactly right.
How
Thank
much does the put cost you at for this particular example?
So it depends. Since you were talking about options, one of the parameters that you calculate in option pricing is volatility. So you don't want to buy right before earnings because that will be very high volatility. So you want to buy typically 3 to 4 weeks before earnings. So that way, they are not very expensive, and typically don't buy it for just 4 weeks, like expiring right after the earnings. Typically, you want to buy it more. You want to buy for more time, so go for like 90 days or something like that. But this is only applicable if you have a very big position in a single stock, and you also have a very good sizable cushion on the stock, say 50 to 80% or 100%. And you don't know, if it gaps down by 40%, you have lost that 40%, right? So, go for those. Don't go for like 20% cushion, and that really won't help because the option pricing will be high at that point.
Thanks, Yogesh.
Thank
Roy,
you. Thank you.
Roy, how about IBM?
It looks great. We like it. This is, I mean, I love the idea that you're picking this up. This is what this is the playbook right here, guys. There's the playbook. There's the pullback. So the pullback to the 21-day, and now the move here to new highs. There's the playbook. And we were talking about this on our last call. Look at this green line breakout. Look, this is fixing to about to have a 14-year breakout. That's significant. So I actually tweeted about this too. I like it. I mean, I like the action here. I love it. If you look at Microsoft, which we had a little position in and we sold it, but we were thinking about buying it back. There's Microsoft when it had that 2016-year breakout. See right there? Microsoft went, 70 to 400. Why can't IBM with a 14-year breakout go from 200 to 400? Over the next year or two.
Especially when Dell jumped.
Yeah. Yep. And so Dell, of course, they're in the server area. Look at that green line breakout. See on Dell right here. See, look, there's the breakout on numbers and good response to the earnings. The pullback here. This isn't the strength that I'd like to see, where it's the 10-day is below the Bible gap up. See, you get my drift here, where it's, you'd like this 10-day to be higher, but it's coming into the 10-day. But Dell is right in the middle of the build out in the servers. So you've got Dell, you've got SMCI, this ANET, which is interesting because this ANET, the numbers on this ANET haven't been explosive, but the action's been very good. And before SMCI hit the world by storm, it was ANET and VRT. We own VRT and sold this stock and took this off into the number as well. Or the number we sold it. We sold it, I think, here. Big profit in VRT. I think maybe the day before the earnings or something.
Well, can you take a look at the stock CEG, Constellation Energy?
Yeah. Yep. This is great. Great action. Look how technically strong this is. This is similar to that BWXT that I mentioned. And this is a really great setup. So we do have a client that owns this, and really strong numbers. And if they're if the build out is going to occur in our grid, and everything that we read, it says our grid is obsolete. You're going to have companies like CEG, you know, BVXT, ST Sterling, STRL, in this infrastructure, building heavy equipment. And so this might be where you get rotation. See, in these stocks like STRL, CEG, and this is picture perfect action. The breakout, the pullback here to the 10-day, picture perfect action. And so this is, you know, this is really telling you that they're in the sweet spot, PWR. So we have noticed this, and this is, you know, this is just something that's only taken place, a trend that's only taken place like in the last 2 weeks.
Mm-hmm.
So this group, I think you've got something. I think you've got something with this CEG. You know, the action is picture perfect.
Roy, about position sizing real quick. I believe you guys mentioned you're going in with 5% or 10% initial position at this point, right?
Yes.
Do you buy it like in one single buy as it's breaking out, or do you have a few throughout the day? Like intraday buys.
It really depends on the setup, and we're the set like we if we can get it without moving the stock too much before having to back off. But I'd like to, and the liquidity too. If like if we had a little, what did we buy today that was a little bit tough getting into? It just depends on liquidity. I mean, if you could hit the button and don't move the stock, just hit it right there. But you know, occasionally some of these you'll move it. You know, if you're buying, you know, 50,000, 100, 200,000 shares. Oh, this IoT was a little bit difficult, and it traded 3 million shares. But it was, you know, we bought, well over 50,000 shares of it just to initiate a position. And it was a little bit tough to get into. But, you know, Palantir, we bought like 150,000 shares of that, and we were able to get into that without moving it, you know, too much. Oh, this, guys, take a look at these two, CPNG. And I'm excited because a lot of these stocks they're showing up. This is, of course, the quote Amazon of Korea, and we're going to look at SE, the Amazon of Singapore. But the numbers, look at the numbers. This is what got our attention. The earnings were great. There's a report. Look at this follow through today. I mean, this is exactly what you want to see. There's the earnings report. Gets back above the averages, back above the 200-day, goes higher, pulls back to the 10-day, and then now turns up. Now it's taking out this 1999 pivot. And there's the volume. Everything like up on volume today. Volume's up 380% today. Stock's up 5%. And, you know, SE, the same type of setup. The ANTS indicator, this is new. There's the earnings, the follow through, and the numbers. Look at the numbers, 2024, up 785%, up 84% next year.
I think CPNG was one of the top holdings for Druckenmiller or something like.
Oh yeah, this is Druckenmiller's second largest position. I think I saw where he bought 23 million shares in the fourth quarter.
SPNG, right? Or SE?
SE.
Uh-huh.
Of SE. And we had the last call was, they mentioned PSTG on the last call. This has come out with a really nice earnings report, gapped up, came in. Our last call in February, one of you guys, we talked about PSTG that was setting up. So that actually worked nicely.
I think PSTG is in a strong uptrend.
Yeah.
But there was a news that Dan Ives reported that they lost like a big percentage of Meta. They had a partnership with Meta,
Oh, really? Really? Okay.
and that's why the stock dropped intraday like 5 or 6%. But
Yep.
it's recovered. So I don't know how real that was.
Yep. Thank you, Amit. Oracle had a really good report. And this is, look at this Oracle. Look at this all-time high right here, all-time high, and really good action on the number. And they blew it away in terms of their cloud, the cloud revenue. APPF. There's the earnings. There's a setup going sideways right here. Nice. So you're getting a number of these. This is where the money should be flowing right here. I mean, they're looking at you. Taiwan Semiconductor. There's the earnings report right there. And who builds the majority of the GPUs for NVIDIA? Taiwan Semiconductor. Oh, the home builders. So Lennar reports today or tomorrow, earnings tomorrow. So, this is, the home builders are holding up great, really. And we're, Toll Brothers, Lennar, and Pulte. And we don't have a position here, but we're thinking this is a secular move.
And there is one more Dream Finder, DFH.
Yeah, this would be one of my favorite, but it's thin. Look at the volume. See, only 367,000 shares.
Mm-hmm.
This is I mean, I love the stock. It's just thin. Looks great. I mean, it's you can't buy, I couldn't buy 50,000 shares of this without moving it significantly, if I just, put in a bid.
Mm-hmm.
SMH, it's important, watch, keep your eyes on this SMH, but it is extended, that SOXL and SMH, that's really negative action right there on that SOXL right there. That's a sell signal for sure. So I would typically short, you get this move here, short on the bounce. You come up here, short on the bounce. So the next few days are going to be fascinating to see if we can, you take this out and gain, take that high out for, NVIDIA, all these, NVIDIA, AMD, AVGO, game on. AVGO, this is, great stock, made new highs, a week ago. Great company, great numbers, big company, fabulous.
Roy, just one off question. So,
yeah,
like CrowdStrike, let's say CrowdStrike or IoT. So they gapped up on earning and huge gapped up. So is it a good idea or how to play? Like, should we wait for little consolidation after earning gap up and then enter, or what is your preference in that?
Normally what we do is I look at use the 5-minute bar and right here, and the first 15 minutes, you want to, once you give it 15 minutes And then if it takes out the high of those, of the high bar of the first 15 minutes, then you can buy it. If it takes out the high, this is why you didn't buy CrowdStrike on the number, because it opened up. This is a 5-minute bar, never took out that high at the first 5-minute bar. So give it, give it the first 30 minutes, the first 15 minutes, the first 30 minutes. For SMCI, which Wes and I were looking at, we were using the 5-minute bar and it never pulled back on the 5-minute bar. And I actually tweeted about this. So we were using the 10-minute, we're using the 5-minute bar. But if we were looking at if we moved it to the 15-minute or 30-minute, we would have gotten filled on the position higher, but it would have gotten us in. So we normally use that opening range breakout setup, give it the first 15 to 30 minutes using the 5-minute bar or the 10-minute bar.
Okay. So it's
and then taking that, exceeding that high for the first 15 minutes, you buy the position, you buy the stock right there. That's where you buy the stock.
Okay, so you don't wait for like couple of days or maybe a week. So for pullback, little bit pullback.
Yeah, that day, and you mentioned, how do you buy the breakouts that day?
Okay.
We want to see if it's gonna work like right now, right then.
Okay, thank you.
So when I'm looking at the earnings estimate of NVIDIA, I see their earnings, they're projecting to grow in 2027 and 28. Like their estimates are like $33 and $43. And 2025 is $24.50 for this year. But on the longer term, they are projecting growth actually. Every year they're showing up growth in earnings estimates somehow.
Yeah, so look at this. Look at this. If NVIDIA does $13 this year, and they're going to do more. Remember, the analysts, they're set up so that they're going to beat the estimate, right? That's what Wall Street wants. So NVIDIA is going to give them a number to beat the estimate and raise the number. But going from this year, if they go from $13 to $23 and $27, there's your 8 quarters right there. That's why this stock could be the most important stock in the marketplace and the most valuable. This should be the most valuable stock in the marketplace.
So unless someone just tells that there is some issue with the earnings estimates and it's down from what they're projecting, until then the stock would go up, right?
Well, if they don't hit the numbers, the stock is more than likely, certainly after you've had this move, any disappointment is going to lead to a knee-jerk reaction. And then what's going to happen is it's going to drop a certain amount, and then you're going to have the value investors and the guys that think that it's dropped enough and that the market quote has over exaggerated the decline, and then they're going to step in, and then that's going to put a floor, and then you're going to get a reflex bounce. And that reflex bounce, depending on what happens, you short it or it recovers, or it recovers as well. That's what's going to happen. That's how these great growth stocks act, particularly as they mature. Bad report, it's going to get hammered. I showed you 5 stocks that we own that got hammered, and NVIDIA's going to be, it's going to be no different. Now the question becomes, do you hold NVIDIA into the next report? Because that's the payoff. Well, if you didn't have NVIDIA, there's the earnings. How much was that up? 16%. So, 16% right there. But, you could have bought it up 16% and still, be up nicely. If you bought the Bible gap up right there. But that was a good report. Bad report, it's going to get bad report. Wall Street's going to panic, and everybody's going to be reevaluating, their numbers and so forth. But what's nice is we have another 10, 11 weeks before they report again. And this stock, I think the stock's going to be appreciably high. It can be appreciably higher by the next earnings report. This stock's at 930. I don't think there's any question this stock's.
But I think by next time they're going to just do some both of this SMCI and Nvidia both are doing a reverse stock split. It just doesn't matter, but they're just doing SMCI is doing 5-1 and Nvidia is doing 4-1.
For what? For split?
Yeah, they're just doing split. It doesn't matter. I mean, we still be getting the same price, but it's just a matter of split. That's it.
Yeah, I haven't seen any. I haven't seen a split announcement. I know the NVIDIA ETF that's like 1.5 to 2 times NVIDIA. That's split either today or tomorrow. But NVIDIA itself hasn't announced a split, or SMCI. And by the way, when Qualcomm announced their, when you go back and you look, when Qualcomm announced their split, that was the peak. They announced a 4-for-1 split, like right at the top. And so, be aware of that. See, look, there's a split. See right there, 4-for-1. When it split 4-for-1, there's the high. So be aware that, you could move up, both SMCI and NVIDIA could move up. But, if these guys announce a 10-for-1 split, there's a good chance you sell right into it. You're going to be, you potentially might be in that blow off phase if that happens. So, just keep that in mind. That's what happened with Qualcomm. It peaked a day after the 4-for-1 split.
Got it. Thank you.
Okay, guys, I think I'm gonna call it a night. It's 10:11. Thank you so much for tuning in. I hope that we identified a number of stocks for you guys and sort of gave you some clarity in terms of how you might best position your portfolio right here. And again, we wanted to convey to you how optimistic we have been and we are after what we just experienced in growth for a 2-year bear market. And again, we think that the danger is missing out on the run. When you see it, the danger is missing out in our view, and not having enough money in Bitcoin. And Bitcoin doubles or triples from here, in the next year or so, based on the happening coming and so forth. But there are a lot of great setups. The market environment certainly has changed. The character has changed. We went over just a number of stocks that are looking great. And, you can expect this market to broaden out. And into other industry groups like the CEG and the power and a number of those setups. So stay tuned and stay engaged, because this can, it's potential. You can potentially make life-changing money between now and year end. And once you have a cushion in your own account, you can afford to take bigger positions and take a little bit more risk. And that's what we intend to do. So our positions are going to probably go bigger as long as they're working. And, as we get more and more traction. So that's how we handle it. We think that's a proper way of managing the upside versus the downside. Watch the new high list. By the way, bar chart, let me show this to you before I tune out. Here on Market Surge, you can see the stocks making new highs, but on bar chart, and as far as I know, this is the only place I've been able to get this. Bar chart, you go to stocks, you go to new highs, new lows. There's post-market trading too, by the way, pretty good site there to see what stocks are doing well after market. But go to the new highs and new lows. And here today, you can see the 52-week highs, all exchanges. Okay, here's the 52-week high list. But then what I want to point out, go down to all-time highs. Your biggest winners are going to be in all-time high territory. So look at the all-time highs. Look, the list is fairly small. There's your list. And, you know, we had 1,500 new highs last week at one time. 1,500. Look at this. That's in 52-week highs. These are all-time highs. Look how small this group is. So you can go here and go through these. See, there's Kava, the insurance company stocks like Ryan, Chubb. You know, they're setting up. There's AGJ, all-time high insurance company. There's Make My Trip. There's Marriott Insurance. There's Oracle, Walmart. So, you know, check this out, because this is, you know, this is the setup that you want to take advantage of. These stocks making all-time highs. No overhead since inception. And these are the ones like that SMCI that can change your life if you know, if you buy it right and you have a significant position and so forth.
Thank you, Roy. This is so helpful.
Yeah, well, thank you guys. I hope you guys enjoyed it. Wes and I love doing this, and good trading for all you guys. We wish all you guys success, prosperity, and we'll see you guys back here next month. So thanks everyone for attending, and we'll get a copy of this with the slide deck in your hands in the next, in the next day or two. So have a good night, and time for a nice glass of wine, I think. Have a good night, guys.
Good night. Thank you.
Good night.
Good night.
Good night. Thanks, Roy.
Good night, guys.